They vow to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Are you thinking of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further, Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.
We are professionals. We are.
Good morning, everyone. Welcome to this session of the CFA exam bootcamp. We're glad to have you all here. My name is Frank Okudadi from the CFA Society office. So we're going to kick off. Literally, it's 9 o'clock. I'm going to hand over to Fola, who's starting off today's session with derivatives. Fola, I'm handing over to you.
Thanks, Frank. Morning, everyone, and welcome to CFA Bootcamp. Like Frank mentioned, we're starting with derivatives, and the first thing I want to say is that it's more numbers intensive compared to what you did in level 1, which was more of an introduction. So what we will do today is I'll just quickly run through some slides, and then we'll take some time to solve some questions. And also, it's also important that you remember a few important highlights which you tested on. So there are a lot of testable points that you need to remember. And there are 2 readings in this in derivatives, which you already know of. And a lot of them have to do with the pricing and the valuation of different types of the derivatives. So I'll just quickly run through some slides, like I said. Just let me share my screen. Kindly confirm that you can see my screen. Anyone, please?
You can see your screen too.
Yes, we can see your screen.
Great.
Yes, we can see.
We can see your screen.
So just a quick recap. So the types of derivatives. So we have our forward commitments and contingent claims. And, the key point to remember is that some are rights and some are commitments. And futures are exchange traded and forwards are traded outside of exchanges. So in terms of the curriculum and the LOSs, the key thing to remember is that our equations are built on something called law of one price, meaning that one asset cannot trade at two different prices, meaning that if they have the same structure, the same cash flows, they wouldn't trade at two different prices, or else arbitrage exists. And every equation, every formula we come up with in valuing any of the types of derivatives or in coming up with the price of any of the type of derivatives are based on this concept called the no arbitrage rule, meaning if there is an arbitrage opportunity existing, market participants will come in and they will take advantage of mispricings and bring the prices back. So the first thing we would look at is our forward contracts. And the first thing to note is that our forward contract, our forward price is just the same as I'm just looking for the points I'm trying to, okay, yes. So the forward price is the same as the compounded value of our spot price. And if that's not the case, if the forward price in the market is different from what we have in our equation, then there is arbitrage opportunity existing. So this is what I was looking for. So in this sense, if our forward price in the market is greater than what we get when we calculate this, of course, this is the risk-free rate, this is our spot price, and this is risk power T. So if this is not, so if our forward price in the market is greater than this, we short the forward and we borrow money, we buy the underlying, we wait till maturity, and then we sell the forward, we sell the underlying at the forward price and pocket some profit when we return the money we borrowed. So that's just basically how it works. There are ways to arbitrage. So you buy the underpriced asset, and then you short the overpriced asset. So that's the whole principle. Now let me quickly rush off to the next slide. Okay. And so in terms of, so let's start with the pricing of forward contracts. So you have your forward price. There's a literature on how this is achieved, but I mean, your forward price is the compounded value of your spot price. If we assume continuous compounding, your forward price is this. I'm not going to talk too much on that. In terms of the value, what would happen is that if we want to value the forward contract in a few months' time, what we would do is we would look at the forward price that we entered into the contract at. We'll look at the price of the underlying, and then we would get the difference. And also, we would not forget discounting the forward price as well, because remember, we will not do the transaction till. So if we enter a 1-year forward contract and we want to value the contract in 6 months' time, what would happen? What would happen is that in 6 months' time, we want to value the contract, but this is when, so if we are long the forward contract, this is when we are buying the underlying assets. So all we then have to do is we would have to look at the price of the underlying and the forward price, and then we'll have to discount this forward price back to the 6 months' time. So alternatively, you may be given in the exam, you may be given a trick question where you are given only the forward price at this time T. So you are not giving the spot price, you're giving the forward price. You already know the forward price with which you entered the contract at. And what then happens is you could get confused because you don't have the spot price. But in this case, you just simply take away the forward price with which you entered the contract from the current forward price. Now this forward price, this formula, you can actually derive it from this one, and that's because so you can actually derive the formula. Let me not waste too much time on that. The next slide, hold on, let me just remove these annotations. Okay, so now we have to consider the cost of carry and the benefits that are attached to whatever underlying that we are writing the derivative on. So if a stock pays dividend, we have to take out the dividend from the equation. So we remove our present value of benefits, which is this CB0 here. We also add the present value of the cost to arrive at the price of the forward contract. So to arrive at the forward price. Let me see if there are any. Okay. Right. So that's a point you need to remember. The fact that you have to, when they give you the cost or the benefits, you include the cost in the equation and you take away the benefits, and it's the present value of the benefit or the present value of the cost. And this is the equation for stock indices, especially when the cost benefits are or the risk-free rates are continuously compounded. So let's move on to interest rate forwards and futures. And the key thing to remember here is that when you are the fixed payer of the FRA, you are long the FRA, and it's OTC. Now, so if you look at this diagram here, we see a whole life cycle of a LIBOR instrument. But then, if we have an FRA, our initiation date is here. So at this point here, we initiate the contract. Now at this point here, we could evaluate our contract. We could evaluate the value of our contract. But at this point here, our FRA expires, and then we discount. Because this is where the underlying matures, so we discount it back to this place. And that's because FRAs are typically settled on advanced settled, meaning that they are settled here. The underlying settles here, but we settle our FRAs there, so we have to discount it back here. And just a reminder on our convention, so a 3 times 9 FRA is a 90-day contract with the payoff in 270 days from now. So meaning that after 90 days, what will happen? So this is our 90 days. This is our day 0. And then this is our 270 days. So 30 times 9, 270. So now what do we do? So this is where the FRA matures, and we discount. So this is our 3 times our 9 FRA contract. Right, and we would look at some questions on how they are practically applied. I'm just going to skip through a lot of this. So in terms of pricing bonds, there are two things we need to consider. We need to consider actually, is this bonds? Yeah, so for fixed income instruments, we need to consider the coupons. And then so for forward rates on bonds, we need to consider the coupons. But then when you are looking at futures, there are two things to consider. You have to consider the things like the conversion factor. And this is because in a bond market, bonds are not as fungible as stocks. So you have to look for the cheapest to deliver bonds if you are short a bond future. So what bond do you deliver? It's not very fluid where you can just take a bond. You have to look for the cheapest to deliver bond, which may not match the structure of the futures that you entered into. So the conversion factor helps you to kind of bring back the structure back to the futures that you entered into. So two things here, besides the conversion factor, you also need to look at the accrued interest. So if you are given if you're given a question where you are given the clean price and the accrued interest, what you would have to do is you would have to add the accrued interest plus the clean price and then use it to come up with the price of the fixed income or the price of the bond. So this is what I'm talking about here. So you have your full price, which is comprised of the clean price and the accrued interest. And then you compound it, and then you have to take out the accrued interest between the day you bought the day you short the futures and the day you are evaluating. And then you also have to take out the future value of the coupons, and which is the same as you just saying so this is similar to this next equation is similar to a forward on maybe a stock, for instance, where you are taking out the present value of the benefit. So you're taking out the present value of the coupons, you're compounding it, and you're taking out any accrued interest that has accrued between the day you enter the futures contract and the day you are evaluating. So for currencies, it's quite straightforward. What you have in terms of pricing a currency is this formula here, and then you value it at a future period. I'm just going to skip a lot of these. Okay, so now in terms of interest rate swaps, we first have to. So you would be given a number of rates, and you would have to come up with the equilibrium fixed rates, which you use to enter a fixed for floating swap. So you could be the fixed payer or you could be the floating payer, but the equilibrium rate is what you would use. So this 1 minus this final discount factor, which would be given divided by the sum of the discount factors, you will have to use to get the equilibrium rate, and you would use that to value your position. So I think I have skipped. Okay, no, I haven't skipped anything. I'm just going to go. So just a few things to remember with currency swaps. Remember that the cash flows so the principal payments are exchanged at the beginning and at the end of the contract, and this is in contrast to other swaps where it's just the interest rates based on a notional principal. So if your interest rate is 4% and you are the fixed swap payer, what you only exchange that 4% of maybe the notional principal is 1 million, 4% of that 1 million. You are not exchanging any principal. So that's the major difference between a currency swaps and other swaps. So the binomial model, so pricing and valuing contingent claims, the first thing for options is you've seen this in level 1 as well, where you have the 1 period binomial model and it takes into account the movement of the stock prices. If the up is the U factor, down is the D factor, and this is what it looks like when you have to come up with the value of the call at this point and the value of the call here and bring it back here with this formula. And then the level 2 now takes it a step further to talk about the 2-period binomial model, where you are bringing these numbers back to time 1, and then you are bringing these numbers back to time 0. So the next thing to talk about is what's the time? Okay. So the next thing to talk about is the put-call parity, and you saw this in level 1 as well, where your protective put must be equal to your fiduciary call. And under put-call parity, you can create a synthetic instrument that replicates anything that you desire. So
give me the rub on the table.
Don't give me a rub.
Someone mute their mics, please.
The sun is drying my nose.
Can we mute our mics, please? Thank you. So the put-call parity concept just states that your protective put should be equal to your covered call, and you may come across a question where they ask you what sort of synthetic, what combination can be used to create a synthetic call or a synthetic stock or a synthetic put, and then you have to rearrange these inputs to come up with this. So for American style options, the key thing to remember is for dividend stocks, it's worthwhile to exercise a call, for instance, before dividend payments. Why? Because you would get that dividend benefits. So early exercise is beneficial for dividend paying stocks, for a call on dividend paying stocks, and early exercise is not worthwhile for a put on dividend paying stocks. Why? Because when you exercise early, you lose all the benefits. You're selling the underlying and they are receiving cash. So you no longer own the underlying and you will not benefit from the dividend payments. So we would look at the hedge ratio sometime later, but what this hedge ratio just means is that you are trying to neutralize your portfolio by buying an amount of underlying securities and maybe selling an amount of calls, such that you have a portfolio where a movement in the underlying security does not change your portfolio, because the value of the calls in the portfolio, the movement of the value of the calls would neutralize that change. So we'll see something like that. I'll in a subsequent slide. And then for Black-Scholes-Merton model, there are a lot of equations that are intimidating, but I think if you can try and just understand the assumptions behind this Black-Scholes model, I think you would be halfway there, because I think you would be more tested on these assumptions than any form of calculations, or they will just test your basic understanding of the Black-Scholes model. So these assumptions, particularly this volatility, I've seen a lot of test questions on volatility, and the key thing to know is that volatility is constant and it's known, and it's arrived at through other inputs from the Black-Scholes model. So you use the market input. So for instance, you use the risk-free rate, you use the price of the underlying, and you use other factors to come up with the volatility. And the volatility is implied, meaning when you have all the other inputs, you use a reiteration process to come up with the volatility. I'm just going to skip through the equations, but you can just go through it in the curriculum. So for interest rate options, so an interest rate option is an option on a forward rate. So it's an option that allows you enter into a forward rate agreement. So a call option on an FRA gains when rates rise. So imagine if you have a call option, because when you buy a call option, you are long the underlying. So a call option on the FRA gains, so this gains when rates rise, and a put option on an FRA falls, gains when rates fall. Just like the concept of options on underlyings, except that the underlying here is an FRA. And then if you are exercising the FRA, it just means that you are going to enter into an FRA with the counterparty. So there are combinations of replicating an FRA. So the most common one is using a long interest rate and a short interest rate put. So a long interest rate call and a short interest rate put. You use this to replicate a fixed rate FRA. What does this mean? So it means that if you are long an interest rate call, it means that you expect interest rates to go up. And then you are short an interest rate put. Remember, when you are short an interest rate put, you also expect the interest rates to go up, but it's just that your risk is higher, meaning that if interest rates fall, then what happens is that you are going to take the other side of the position of a long interest rate put. So there are other combinations. So a combination where you have a short cap and a long floor is the replication of a receiver swap. So all these things are things you need to remember. All these combinations, just go through them and try and understand them and remember them. So we have the swaptions, which is the right to enter into a swap at a future date. So it's an option on a swap as well. You can take the payer leg of the swaption or the receiver leg of the swaption. And then I think this part is also important as well in terms of the Greeks. Now, the first thing is your delta. Your delta measures the change in asset prices and how they affect the change in option prices. And one could see that when an asset price goes up, then the value of a call as well go up. If you just write down that formula, that our ST minus X. So as this goes up, the value of the call goes up. For a put, our X minus ST. So we see that there's a negative relationship between our underlying and our put, and a positive relationship here. So the delta here, so just the thing to take away from this is that the delta is positive here for call and the delta is negative for a put. And I've summarized the relationships here. And then for gamma, gamma measures the rate of change in delta as the underlying stock price changes. So sorry, the other things I forgot to mention with your delta is that, hold on. When your delta, so your delta is closer to 1 when your call is in the money. So there is a strong change for a call option. There is a strong change in the call value when there is a change in the underlying when the option is in the money. But then it's the opposite when the option is out of the money. So your delta tends to 0 when the call is out of the money, which makes intuitive sense because you have your call option out of the money. That change will not be, there won't be a strong degree of responsiveness in the price of the call. Now, for puts, the value of the put is negative, and there is a negative relationship, and a put option delta will increase so a put option delta is close to this. So this is the continuously compounded dividend multiplied by the time. So this exponential of this, your put is closer to this when the option is in the money. And remember the negative is for the negative relationship. And as the put delta increases from -1 to 0, the put delta increases from -1 to 0 as the stock price increases. So deltas tend to be 0 when the call option is out of the money. So just like a call, you have an out of the money option, the delta is close to 0. So there are other tricks, but for gamma measures the change in delta as the underlying stock price changes. And the important point here is that gamma for the money options, gamma is highest for the money options. Deep in the money or out of the money options have low gammas. And then we have theta, which measures time. We have, what else do we have? We have the rho, we have vega, which measures volatility. So I'm just going to skip through that. And then there is a dynamic hedging. We talked about dynamic hedging earlier on, where you have a number of calls to hedge, and the number of calls you are going to hedge to achieve a delta neutral portfolio is this. So you have to use your number of shares and divide this by the delta of the call option. And for a put, it's a negative also associated with the equation. So, but the key points here is that as the underlying stock price changes, the delta of the call and the number of calls that need to be sold to maintain the hedge position also change. So continuously maintaining a delta neutral position involves significant transaction cost. Why is that? Because as the price is changing, our delta is changing. So we have to also then we have to then sell more calls in the portfolio to continue to maintain that delta neutral position. And lastly, we talked about implied volatility earlier on, which is the continuous compounded, standard deviation of the continuous compounded asset returns. And one thing to note from this is that implied volatility is based on a few inputs, and is also heavily dependent on the past returns of the stock price in the past. So it's dependent on a lot of historical figures. And you use implied volatility to gauge market perceptions. So let's just quickly, go to a number of questions. And let me just change my view. Hold on. So please let me know if you can see my screen. Let me increase this.
Yes, we can see your screen.
Okay, thank you. Right, so if we can, I want us to also participate, particularly for the ones that are not calculations. So the first one is this: an analyst who mistakenly ignores the dividends when valuing the short position in a forward contract on a stock that pays dividend will most likely Which of the following? So is this person overvaluing the position? Is he undervaluing the position? Or what is this person doing? So we need to remember this, when we are valuing our forward contract. So this is our ST minus the present value of our benefits, which could this could be dividends, this could be coupons, plus the present value. So this is to the long now, present value of the cost, and then minus the present value of our forward contract. So here, what we are saying is this person mistakenly ignores the dividend for a short, not for a long. So for a short. So what happens? Whatever the gain is whatever the long is gaining, the short is losing. So this is for a long. Now for a short, when you include this minus, everything changes. So what happens? The present value, so this is minus ST plus the present value of your benefits minus the present value of your cost plus the present value of our forwards. Right? So now this analyst ignores this whole thing. So let me see if anyone has. Okay, someone says, oh, I think there are a number of questions here. Oh, there are a number of comments here. So in the days, hold on. In the days convention for index, do we use 360 or 365? We use 360. We use 365. And we only use 360 when we are looking at LIBORs and we are looking at FRAs. And our market reference rate is LIBOR. That's when we use 360, but it's usually 365. FRA, swaps, caps, floors, okay. Yeah, for index, we use 365 days. Please, can we solve a couple of questions on areas? Yes, we will look at questions. How is accrued interest calculated for forwards? Yeah, so we would look at this shortly. Undervalue. So this person, so the option here I'm seeing is undervalue. Why? Because your present value of your benefits is ignored. So you are undervaluing the position by the present value of your dividends. The next question is, a portfolio manager owns this stock, which is currently trading at $35 a share. She plans to sell the stock in 120 days, but is concerned about the price decline. She decides to take a 120-day forward contract on the stock. The stock will pay $50 dividends and $35 again in 125 days. The risk-free rate is 4%. The value of the contract in 45 days, assuming our stock price is this, is closest to what? So the first thing we need to look at is we need to come up with the present value of our, benefits, which is the dividend in this case. So the first thing to do is to remember that formula for coming up with the forward price that incorporates our cost, which is our S0 minus present value of benefits. So this is the present value plus present value of our cost okay, multiplied by 1 plus, I'm sorry if you cannot see my writing, 1 plus RF. So now, someone was asking about future value of benefits. How are they calculated? So the first thing, so if you want to use the future value, what you can then do is, this is our future value of our S, because they are expanding by this, and then this is our future value. So this PV, so this is minus our future value, so minus future value of our benefits, because you are multiplying this times this. So how do you calculate the future value of this? So what you do is, in this case, so for future value of benefits, if you don't want to use present value of benefits, if you want to use future value of benefits, you have a situation where so imagine if the contract is 120 days and a dividend is going to be paid in 90 days. Now, this is day 0. The future value of the benefit is so if the dividend is 50 cents, so 0.50. So what you then do is you then say your 50, so the future value of this benefit is this 0.5 plus 1 plus whatever the interest is raised per. So because the contract is 120 days and the benefit is being paid on day 90, what would happen is that you are going to enjoy this benefit for 30 days over the contract. So that will be 30 over 120. So that is using the future value. So if you want to use the future value, or if you are giving, if that's what you prefer, so that's how it is. But in terms of the present value, let me clear. Oops. So now, what the first thing we do here is we look at the question. What's the question asking? This person takes a 120-day contract. Now, a dividend is paid in 35 days. So this is 35 days. A dividend of 50 cents is paid here. Now, another dividend is paid after the contract. So this one is paid here. So the only dividend that concerns us here is this one, because it is the only one paid within the contract time frame. So what do? We find the present value of this. So this is 35 divided by 1. What's the risk period? 0.04. 1.04. 1.04 raised to power 35 over, so this is not 35 actually, this is 0.5, sorry about that, 0.5, because this is dividend that is paid. 35 over 365. So now, let me just calculate this. So you have 34.9496. So now you have the present value of your dividend. The next thing to do is now to input whatever figures into that formula, incorporating your cost. So now the stock price is 27. So you are still looking for the forward price. So the forward price is 35, sorry, actually not 37. 35, 35 minus, sorry, 30, how do I erase? Okay. So 35 minus sorry, I made a mistake here. So this is supposed to be 35 minus 0.5 divided by 1.04 raised to the power 35 over 365. So we take away the present value of this, and then we then compound this. So plus 1.04 raised to the power. So it's a 120-day contract, 120 over 365. Sorry if you can't see my writing, I'm struggling with. Okay, so when you do this, you get a forward rate of this 34.9496. Now, with this forward rate, we're asking the value of the trader's position. Now, what do we do in this case? This person is short, and the value of a short is your F, discounted F minus our S. Now, the next thing to do is to then discount your 34. So we are now in 45 days. So we are looking for the value of the forward contract in 45 days. So it will be your discounted forward. So we're at 45 days. We have 75 days left. That's 120 minus 45. We have 75 days left. And we then compare it with the current price. So this should give us the answer. I don't have a cap. I don't. If someone can help us calculate this. 7.17, so 7.169, thank you. So this is 7.17. Okay, so let's quickly move on to the next question for the sake of time. So I'm not going to do this because this is very straightforward. Yeah, it's very straightforward. Or actually, let me just do it. So what will happen is, first of all, you have to get the present value of the coupon. So this, a 6% treasury bond is trading at 1044. So this is the price of the coupon per 1,000 face value. It will make a coupon in 98 days from now. The yield curve is flat over the next 150 days. The forward price of the face value for a 120-day forward is what? So the first thing I need to highlight here is that remember that this has given us the accrued interest at time 0. If you were not given, so if you were given a clean price and an accrued interest at time 0, you would have to add these two to get your S at time 0, so your SO. But now you are given the two, so you are fine. So the next thing to do is to look at your cash flow. When is the next cash flow? What is the cash flow and when is it coming? So we have a coupon of 6, so 0.06 multiplied by 1,000. What else? It does not say whether it's a semi-annual coupon or an annual coupon, but a lot of times we assume that it's semi-annual. So we divide by 2. So we have $30. That's our cash flow that is coming. It's a benefit. So what do? we say our F0 is equal to our price, the price of the coupon, minus present value of our benefits multiplied by 1 plus R. So what do we have? We have, what's the price? It's now trading at 1044. So 1044 minus 30. It's going to make a coupon in 98 days. 30 divided by 1.05 raised power 98 over 365. So, and then we would have to then compound it. So that is 1.05. How many days is our forward contract? Raised to power 120 divided by 365. Now, this should give us our answer. If anyone can help us with the calculation, would be much appreciated. Can anyone help me with the answer, please? Please, why 75 over 120, not, where is it? Not 365. Hold on, let me, someone is asking a question. Why 75 over 120, not 365? Sorry, it's probably a mistake. It's supposed to be 3. So it's supposed to, I think you're referring to the previous question. So it's supposed to be 75 over 365. Sorry about that. So it's 75 over 365, you're right. So someone says 103.0.79, which is B here. So the next question, let's quickly go on to the next question because we still have a lot to cover. Clear our drawings. Let me see if there are other questions. Okay. Why do we assume it's semi-annual? And that's the convention. It's usually so in the exam, you would be, I can guarantee you that if you were given this question in the exam, you would be told what the frequency of coupon payments are. But a lot of times when I see questions that don't give the frequency, bonds are typically semi-annual. So I just assume that it's semi-annual. And I think these guys should have, I think I got this question from Schweizer, they should have stated it clearly that it's a semi-annual payment. But in the question, you'll be told whether it's semi-annual or not. Okay, so the next question. So this is just testing our understanding of an FRA, how FRAs are priced. Now, the contract rate for an annualized 3 times 5 FRA, if the current rate is 4%, the 90 days is this, the 150 day is closest to what? So the first thing we need to look at is it's so confusing. Okay, so the first thing to look at is for an FRA, we first look at the the time to maturity of the FRA, which is this, and we look at we look at the payoff, what determines the what's it called? The payoff, the time of the payoff, the time that the payoff is made. So it's the payoff determined by this market reference rate. So what we need to do is, so a lot of times people get confused with the formula. So what I just typically do is I just say that what's it called? I just say that our a1 plus 0.04 90 over 360. So this is for this three. So this is 3 months. This is 90 days over 360. And then I multiply it by 1 plus so whatever difference. So this is 3 and 5. So between 3 and 5, we have 2 months, which is 60 days. So this is 1 plus whatever the so we are looking for that forward rate. We are looking for that forward rate, that no arbitrage forward rate that would give us the 60-day rate of 4%. So FR 60 over 360 is equal to 1 plus 0.06. So this is the 150 days, 150 over 360. So we walk around this, and so when we walk around this, we should get, so that is 1.025 divided by 1.0125 minus 1. And then we then bring our 360 over 60 here. So if someone can just help us with this calculation. Okay, 7.4%. Okay, so that's it. No, okay, so now let's quickly go on to the next next question. Right. So the CFO of this company received a report from the economics department that states that short-term rates are expected to increase by 50 basis points. So as a floating rate borrower, the CFO recognizes that he must hedge against an increase in future borrowing costs because of a potential increase in short-term interest rates. He considers many options, but decides on entering into an FRA. So he's entering into an FRA. The 30 days LIBOR is 45. This one, 90 days, this 180 days. So to best hedge the risk, Yellow should enter into a. So these options have actually helped us narrow down what we are looking for. So we know that we are going to do an FRA, but we are just looking for that convention, and we are looking for the rates that we would use. So now he says that, where is the question? He enters a long FRA, so he's the fixed payer of the FRA. Also, he wants to enter it in the next 90 days. So the next 90 days is 3. So the next thing is he wants to enter a 30 days. There's nothing like 3 times 3 FRA. So this is out of it. So also it says that the floating rate borrower wants to, he wants to do it against a 90-day LIBOR. So you have this. So this is today. He wants to enter into an FRA in 3 months' time. Also, he wants to do it against a 90-day LIBOR. So from here, so if he does it against a 90-day LIBOR, here, so this 3 months plus another 3 months is 6 months. So this is 90 days against a 90-day LIBOR. So we have 0 here. And from here to here is 180 days or 6 months. Please show the last question. Okay, I'll get back to you now. Let me just finish this question. Now, what we are doing is we are saying that you are going to enter so we know that it's a 3 times 6. Why is that? Because the borrower wants to borrow, he wants to borrow in the next 90 days, which is a 3, and he wants to borrow against a 90-day LIBOR. So you want to borrow against a 90-day LIBOR at this point here. When you get to 3 months time, you want to borrow against a 3 months LIBOR. So this convention is 3 times 6. So now we need to know whether it is 4.48 or 5.02. That is where our calculation comes in. So what do? We then say, hold on, please. Okay, so we then use our formula to come up with our FRA. So we then have our 1 plus 0. What's our 3 month? What's our 3 month LIBOR? Plus 0.047 multiplied by 90 over 360 into 1 plus our fixed rate multiplied by, so this period, another 90 over 360 equals to 1 plus, what's the rate here? 180 days, 0.049 into 180 over 360. So what do we have? When we rearrange this, we can then have 0.47 times 4. So that is 1. So this is multiplied by 0.5. So we have 1 point, I think it's 0.245 divided by 1.01175 minus 1, and then 360 over 90. So we are looking for that FRA. So can anyone help us with this? Sorry, Chima, okay, what question are you talking about? Okay, so it's 502. So we enter a 5, it's 3 times 6 FRA at 5.02. So now, the next one we want to look at is the pricing and valuation of a currency forward. I'm not really going to go into this. This is just putting the numbers in a formula. So just putting the numbers in your so this is your the price of the price currency multiplied by 1 plus risk-free rate in the price currency market, raised to power t, divided by 1 plus our risk-free rate in the base currency market. And just a reminder, if you see something like 0.923 pounds per euro, just remember that this is the price currency and this is the base currency. So the way you can remember it is that the euro is here, euro is at the bottom, so pound per, the euro is at the right, it's at the bottom, so this is the base. And this is the price currency. And you use the price currency as the numerator here. So yeah, so that's about it there. Let me move on to the next question for the sake of time. So now we are on pricing and valuation of interest rate swaps. The immediate past question. We are not having same answer as yours. Let me see. I might have made a mistake somewhere, so I might have made a mistake somewhere here. So maybe it would have been this or this. I'm not sure. But because of time, let's just move on. So now, two parties enter into a, hold on. Two parties enter into a 2-year fixed for floating interest rate swap with semi-annual payments. The 180, 365 rate analyzed are this. The swap rate is, so what we are looking for is that swap rate. Remember the formula for getting that equilibrium rate, where we say you have our 1 minus, we've been given, so I think Schweizer uses Z, so I'll use Z. So we use our 1 minus Z4, which is this one, divided by the summation of all the Z's. So luckily, you'll always be given that discount factor, so you don't need to discount it. It's already been done for you. So our swap rate is 1 minus 0.8772 divided by the sum of all this one. So we just sum this 0.9756 plus 0.9434 plus 0.9112 plus 0.8772. So when we do this, we should be able to get the swap rate. So whatever we get, because it's not annualized. Hold on. It's not annualized. We would have to annualize it. So can anyone help with the calculation? Quickly, anyone? Okay, so 6.62. Is this 6.62 annualized? Did you multiply it by 2? Or? Okay. So you did it and you multiplied it by 2. Okay, that makes sense. So you have 3.31. And then you annualize it, so that's 3.31, 360, 180. So you get 6.62. Now let's move on. What's the time? 10:06. Oh, I still have a lot to cover. Yeah, I'll join this. So after 180 days, when the swap is marked to market, sorry, the swap is marked to market when this annualized at this is the present value of the factors respectively are this. What is the market value of the swap per $1 notional, and which of the counterparties would make the swap payments? Right. So the first thing to do is to come up with the current market value of the swap. We already know that, let's look at, because it follows up from the previous question. So this is a fixed to floating. So the fixed one, so we are the fixed payers, and our fixed rate is 6.62. Now we have to calculate what the current swap rate is, and then we have to discount it as well. So what do we do? 180 days later, so we enter the swap here. 180 days later, we are here. We are trying to value the swap. It's a 2-year swap. So this is day 0. This is day 720. Remember, it's a 2-year swap from the above question. But here now, we are in day 180. We are in day 180. So 720 minus 180. Sorry, hold on. Okay, so the next thing to do is we then calculate what our current rate is based on these discounted factors. So we get our equilibrium discount rate. So this is 1 minus 0.9174 divided by the sum of all this. So please, can someone just help us with this, so we can use it to value our swap? Okay, so we have, someone says 5.8. I hope this is correct. So we have our 5.8, and I'm assuming this is annualized. Now we have our 5.8, we have our 6.62. The fixed rate payer is this. Now the fixed rate payer is going to pay 6.62. So the fixed rate payer is going to pay 6. So rather, this should be a minus, because the money is leaving your account. So you are going to pay 6.62, and you are going to get 5.8%. Remember, we are looking at this as the notional principal is $1. So what's happening? We are here, we are in day 120 here. Now, from day 120, we are here. We have to discount all the payments. We have to assume that this is our cash flow over the next periods, and we have to discount them back. So we have our 5.8 minus 6.62, and remember what we are paying is, we are paying, because it's every 180 days, we are paying this divided by 2. I hope I make sense. So we are paying this, and we are doing this 5.8 minus 6.62 multiplied by a notional principal, and we are dividing it by 2 because it's a 180 day it's a 180 day swap. So now what do we do next? We've divided by 2. We multiplied by 1. Let me erase this. So this is number. So we've multiplied by 1, which is our notional principal. The next thing to do is to discount this. We are discounting it over 180 days. So at this point, assuming we are at day 0, we have to discount it over 180 days, over 360 days, and over, so this is now 540. So we are discounting it, and we have the discount factors already. So this is like saying this value multiplied by this plus this value multiplied by this plus this value multiplied by this. So it's like you're coming up with the present value. So what do you then do? So this is now 5.8% minus 6.62% divided by 2 multiplied by the summation of all this 0.978 plus 0.9524 plus 0.9174. So when we do this, we should get the answer. So we should get the answer. I don't know what it is, but the only thing I know is that the person that would make the payment is the fixed rate payer. So A or B is correct because you are paying more than you are receiving. So the net amount is going to be paid by the fixed rate payer. Let's go on to the next one. You can calculate it to see which one it is, but I know that it is one of these. So let's just, are we annualizing with 2 years or less? Are we annualizing with 2 years or less? I don't understand the question, sorry. Are we analyzing which one? Okay, how did you annualize after 180 days? Okay, so this is where we are here. We are at 180 days. All we did was we did the same thing. We calculated the equilibrium rate the same way we calculated the other one, where we just said 1 minus 0.9174 divided by the sum of this. When we got this, when we got the value, we multiplied by 2 to annualize it. So we multiplied by 2 to annualize it. We didn't annualize by 2 years. We annualized because it is a 180-day LIBOR and 360 divided by 180. So it's like you're saying you're bringing it up to, so it's every 6 months. You're not annualizing it to 1 year, so that it will be 5.8% per annum. Okay, so let's move on. Is it not less than 2 years? Okay, sorry. We are running out of time, and there are some questions I want to cover. So let me just go on to the next one. Okay, so the next one, the current US dollar to this is 0.7 in a fixed for floating swap. The party that is entering the swap to hedge an existing position to a Canadian dollar fixed rate liability will. So let's look at the question. It's saying that this Canadian person, this entity, wants to hedge an existing exposure to a fixed rate liability. So what does that mean? It means that this person wants to receive Canadian dollars, fixed rate Canadian dollars, to hedge their own liability. So the person wants to be receiving Canadian dollars. So what can this person do? So this person is probably somebody that is in the US, probably an American, that was only able to, a US company that was able to get Canadian. So this person was able to get Canadian dollars. Now, with this Canadian dollars, this person only wants to hedge themselves, and this person probably makes their money in US dollars. Now, what this means is that this liability that this person got in Canadian dollars, he can transfer it to another counterparty. When he transfers it to the other counterparty, he'll be receiving interest payments in Canadian dollars and be paying interest payments in US dollars, so that will form the swap. So now let's look at this. So you want to hedge your Canadian dollar liability. What happens at the beginning of the contract? You pay $1 million. You pay 1 million Canadian dollars. You pay 1 million divided by 0.7. So you pay 700,000 Canadian dollars. I hope I'm making sense. So you're paying 700 because the exchange rate is 0.7. So you're paying 700 Canadian dollars to a counterparty, and you are receiving $1 million. So this is what you receive. What then happens? The counterparty pays you interest rates in Canadian dollars. So the counterparty pays you interest rates in Canadian dollars. So what happens? At the termination of the swap, what would happen? Would you receive $1 million at the termination of the swap? No, because you paid $1 million at the initiation. You paid 1 million Canadian dollars at the beginning of the swap. So you should receive 1 million. You paid 700. Sorry, I'm just sorry about the mistakes. You paid, hold on, dollar to Canadian dollars. So this should be, so you paid 1 million, not 700 Canadian dollars. You paid 1 million divided by 0.7 to the counterparty. So you paid whatever it is to the counterparty, and you have to receive that amount when the contract expires. Now, what would you do? Would you pay a fixed rate based on the yield curve in the United States? Or would you receive a fixed rate based on the yield curve in Canada? So what happens is you've paid, you've paid some money in Canadian dollars. You will then receive a fixed rate based on the Canadian yield curve. So C is the answer here. Let me see if there are any questions. Okay, so the next question. Let me skip some questions and go to some more theoretical questions. Okay, so the first question here is, hold on, I saw a question. Okay, so a synthetic European put option is created by what? What do we think the answer is here? Remember, synthetic just means that you are bringing that that put call parity. You are bringing it to play. So you are using the put call parity to come up with the value of the put. So what does this mean synthetically? Can anyone help with an answer? A. So you are buying this discount bond, you're buying the call option, and you're short selling the stock. Thank you. So the next question. So compare the call and the puts. Hold on, please. Compare the call and put prices on a stock that doesn't pay dividend with comparable call and put prices on another stock that is the same in all respects, except it pays dividend, which is most accurate. So, so when a stock pays dividend, it is less, so the call on the stock is less valuable than a call on the stock that pays dividend. Why? Because for a call that pays dividend, for a stock that pays dividend, we will not benefit from the dividend if it's a European call. We will not benefit on the dividend because the only time we can benefit is if we exercise the call and we own the underlying. But because we do not own the underlying, we would not benefit. And for a put as well, an underlying that pays dividend, a put on a call on an underlying that pays dividend is more valuable because you can derive some benefit from the asset that pays the dividend. So which of the following is more accurate? What do we think the answer is here? So no div will be, a DIV call will be less than the price of a no div call. So let's look at it. We said these two stocks don't pay, the stock, a no div does not pay dividend, but div pays dividend. Now, a div call, so the value of a div call will be less than the price of a no div call. So what do we think? So this pays dividend and this doesn't pay dividend and this pays dividend. So a no div call, will be less than the price of a no div call. So a div call pays a dividend. So it will be less than this. So I think, so let's look at the next one. A no div call will be equal to the price of the put, no. A no div put will be greater than the price of a div put. So I will go with A. Can we have these questions? Yeah, I would send the questions over to the organizers. I have less than 5 minutes to go, so we would, okay, someone says A. So div pays a dividend, so it will be less than no div. In terms of puts, no div does not pay a dividend, so it will not be greater than the price of div because div is more valuable as a put. Now let's look for other one-off questions. So number 2, so this, which of the following is not an assumption of the underlying the Black-Scholes model? So what do we think? Is not. Yes, I was referring to the value of the puts, yes. So this question, which of the following is not an assumption underlying the Black-Scholes model? What do we think the answer is here? Black-Scholes method options pricing model. A, the asset does not generate cash flow. I think that is an assumption, isn't it? Is it not an assumption? I can't remember as well. Let me just quickly check, sorry. Okay, we have 3 minutes left, so I think this will be the last question. So, okay. Okay, so there is no dividend. Okay. I'm not sure what the answer is, to be honest, because I can't really remember if assets generating cash flow is an assumption or not. Underlying asset does not generate cash flow. So what you're saying is underlying assets generates cash flows. So that is an assumption. It's a log normal. I know that the option it's a European option. And then yes. Yes, because someone says I think it's B.
It's
because
A.
It's A. Okay. I'm not sure, but I mean, I'm not sure as well. I don't know the number. The assumptions are just jamming in my head. I can't remember. Continuous, constant. Okay. B and C are assumptions. And you're sure it is the price that is log normally distributed? Okay, yes, the price. Okay. All right. So A seems to be the answer. Right. So I think we can look at one more question before we go. Which of the following statements is least accurate? The value of a call option will decrease as the risk-free rate increases. So what do we think the answer is here? What do we think the answer is for this question? Right, because of time, I'll just quickly give the answer. So the call option will decrease as risk-free rate increases. So A is the answer because A is not accurate. So A is not accurate. B and C are accurate. Okay, so my time is up. Thank you very much for listening. And please, if you didn't understand or you didn't get anything, I think you can just go over your curriculum or go over your Schweizer notes, and as much as possible try and solve as many questions as you can. I'll send over these questions at somebody's request. At this point, I would hand over to hold on. I would hand over to Ibrahim Salami, who will be taking you on quantitative methods. Thank you and good luck.
Thank you very much, Fola. Ibrahim Salami.
Hi, thank you, Fola. Good morning.
Welcome.
Yeah. Good morning, everyone.
Good morning.
So my name is Ibrahim Salami. I'll be taking you on the quantitative method class. So let me just call up my notes. Okay, so we'll be taking the I'll be taking on the QM topic, right? Like, as we all know, the QM topic has 5 topics or 5 readings, which is introduction to linear regression, multiple regression, time series, machine learning, and big data projects, right? We'll do a quick rundown on some of the important aspects of the reading, right? The things you should take note of. Then maybe we'll use like 30, 45 minutes to do a quick rundown. Then we'll use the remaining 1 hour to solve some selected questions, right? I hope that works for everyone. Okay, so, sorry, the first reading, which is Introduction to Linear Regression. So the first thing you need to know is, you need to know the form of a linear regression, right? And it's typically in the form of y equals to b naught plus b1 x1 plus an error term. So you need to know what makes up this equation. Y is the dependent variable, which is that variable you are trying to predict. X1 is the independent variable, which is what you are going to use to predict or try to explain the dependent variable. So you need to be able to determine what is your dependent variable and what is your independent variable, right? Your B naught is your intercept, and your intercept is defined as the value of your dependent variable when your independent variable's value is what? 0, right? That's how you define your intercept. And your B1 is this coefficient or the slope, which is the rate at which your dependent variable changes for every unit change in your independent variable, right? That is how you define your B1. If this looks so confusing for you, just take your mind back to when you were in secondary school and you did an equation that looks like y equals to a plus bx, right? When we have that equation when we're in secondary school, you know y is what you're trying to predict, a is your intercept, and b is your what? Your slope. So the same thing we're saying here, the b1 is your slope, right? And that's what measures the degree of relationship between the dependent variable and what's the independent variable, right? Also, you need to be aware of what you call correlation. Correlation measures the strength of relationship between the dependent variable and the independent variable. Correlation is different from your slope. What correlation just shows you is just shows you the kind of relationship that exists, right? If they both move in the same direction or they move in different directions, that's just what correlation shows you. But your slope actually shows you the rate at which they are related to each other. And we all know how to calculate our correlation is what? The covariance between the two variables divided by what? The standard deviations of each of the variables. So for correlation is what? Covariance between maybe x and y divided by what? Standard deviation of x, standard deviation of y. That is how you define correlation, right? But I'm saying correlation is different from what? Your slope. Correlation only shows what? The kind of relationship that exists, but it doesn't show you in actual times or in magnitude times what the relationship itself is, right? So we need to go to a simple linear regression model. So our simple linear regression model is what? Y cap, this line here, Y cap equals to B naught cap plus B1 cap X1. The B naught cap and the B1 cap are what? They are predicted values, right? Because the original B naught cap itself, B naught and B1 itself are not observable terms. So you need to find a way to get them. So you have to predict them. So which is why we use what? The predicted model. And in the predicted model, your B1 cap is calculated as what? Covariance between the dependent variable and the independent variable divided by what? Variance of what? The dependent variable. And that is what? Your B1 cap, or which is your what? Your slope coefficient. Then your B naught cap, which measures the intercept, it's a line that passes through what? The mean of your dependent variable and the independent variable. So it's a line that equates what? The mean of your dependent variable to what? The mean of your what? Independent variable. So it is what? B naught cap is equal to what? Y mean minus what? The B1 cap you calculated earlier multiplied by what? The X bar, which is what? The mean of your what? Independent variable. So the best regression line or the slope is the one that what? Minimizes what? The sum of squared errors between your actual Y, right? And your what? Predicted Y. So your Y minus Y cap. The slope is the one that minimizes what? The sum of this squared error. So you should understand that. And that's what linear regression is all about, because we are using what? The least squared method. That's what we use. In carrying out your linear regression, there are some assumptions made, right? Which is what? There must be a linear relationship that exists between what? The dependent and the independent variable. The residual terms, which is the difference between the actual and the predicted value, or what you call your residual, must have what? A constant variance, which you call what? Homoscedasticity, right? The residual terms must have what? An independent distributions. That means what? You must not be able to predict them from just looking at them. You must not be able to predict them. They must be independently distributed. And also they must have what? A normal distribution. Normal distribution in the sense that that is only when you can carry out what? Statistical tests on them. So remember the assumptions. A linear relationship must exist between the dependent and the independent. There must be constant variance, which is what we call what? Homoscedasticity. Then distribution must be what? Independently distributed. The residual terms must be what? Independently distributed. And the residual terms must have what? A normal distribution. Now that you've generated your regression line, you want to test how good your residual line and your regression line is, right? So you carry out what we call what? An analysis of variance. Variance is what? The difference, or variation is the difference between what? The actual values and the predicted values. So you want to try and explain what is causing this difference, right? So we try and analyze the variance. You have to know the variance has two components. The one that is explained, right? And the one that is what you cannot explain, that is due to error. So the total variance is what? What you call what? The sum of squared, right? That's what you call the total sum of squared. That's what you call what? The total variance. And it's the difference between what? Your actual Y and what? The expected value of your Y, which is what? The mean of your Y, right? And you find the square of it. That's what? The total variation you are looking at, right? This total variation is made up of two variations. One is what you call what? The explained part, or what you call what? The regression sum of squares. And the other part is called what? The error part, which is called what? Or the unexplained part, which is called what? The sum of what? Squared errors. The explained part is what you call RSS, and is the difference between what? The predicted value and what? The expected value. right? And you find the square of it, and that's what you call what? Your RSS, right? Then the error part, which is the sum of squared error, or what you call SSC. Who is that?
Mike, please.
Can you please mute that person, please? Okay, all right, thank you. Then the error part or the unexplained part is what? The difference between the actual Y value and what's the predicted value, which is the part you could not predict, right? So we said that what? The total sum of squared is what? The sum of what? RSS and what? SST. So we say what? Total sum of squared, SST, is equals to what? RSS plus what? SST, right? That's how you get your total sum of squared. Also, in determining how good your regression line is, there are three things you consider. One is the what? Standard error of the estimate, which is also what? The standard deviation of what? The residual terms. And it's calculated as what? Square root of your what? Mean squared error. So I will show you how to calculate that in the next page, right? What you're looking for is this. Between two models, you choose the model that have what? The lower standard error of estimates. That's the one you choose. Then you also use what? The coefficient of determination, which is what? R squared. The R squared is what? The ratio or the fraction of the what? Explained variation, which is what? RSS divided by what? SST. That's how you calculate that. And you choose what? The one with what? The highest or the higher coefficient of determination. For a simple linear regression, you can also calculate your coefficient of determination by finding what? The square of your what? Correlation, right? You can find your R squared by just simply squaring your correlation for a simple linear regression where you have just what? One independent variable. Then the third one is what? You use the what? F statistic. The F statistic is what? Your mean squared regression divided by what? Mean squared error. And that gives you your what? Your F statistic. You choose the one that has what? Higher value if you are comparing between what? Two models. So let's look at a typical ANOVA table, right? So this is a typical ANOVA table. This is how it comes out. You have your sources of variation, and you have what? The explained variation and the what? Unexplained variation, right? So you have that, and you have the unexplained variation. Then you have what? The degree of freedom. The degree of freedom for your explained variation is K. And K simply means what? The number of independent variables that you have. That is what you call what? K. Right? That is K. Then for the error part, the degree of freedom is what? N minus K minus 1. Where K is still your number of independent variables. So for when you have one independent variable, your K simply becomes what? 1. And your N minus K minus 1 equals what? N minus 2. So that is your what? Your degree of freedom. Right? And your total degree of freedom for your regression is what? N minus 1. Then your sum of squares, like we explained, for the regression is what? RSS. For the error term is what? SSC, which is sum of squared errors. And the total is what? Total sum of squared. Then for their mean, MSR is calculated as what? RSS divided by K. And MSC is calculated as what? SSC divided by N minus K minus 1. And that's how you calculate your mean squared error. Then for your F statistic, your F statistic is what? MSR divided by what? MSC. And your MSR has a degree of freedom of what? K. And your MSC has a degree of freedom of what? N minus K minus 1. So we should take note of this. So the F test is used to test for the overall significance of what? Our regression equation, right? But if you want to test for the significance of each of the coefficients itself, we use what? T-test. We use the T-test to test for the significance of each of what? The coefficients, right? And it's simply what? The value of our coefficients minus what? The hypothesized value divided by what? The standard error of the coefficients, right? Most times we mostly test for what? When your hypothesized value is what? 0, and that's what we usually test for. Next, we need to know what your p-value is. Your p-value is what we call what? The smallest level of significance at which you reject your what? Your null hypothesis. So what we are saying is this: if you have a model that has a coefficient that has a p-value of 5%, for example, it has a p-value of 5%. What we are saying is this: if your level of significance is 7%, then you have to reject the null hypothesis, right? Because 7 is greater than what? 5. But if your level of significance is, say, 3%, then you cannot reject what? The null hypothesis. The beauty of the p-value is that what? Once you are given the p-value, it reduces the amount of calculation you have to do. So you don't have to do any t-test calculation again. Just compare your level of significance towards your t-value, and that is to your p-value, and then you can make your decision if you are to reject or not to reject, right? Next is what? You have to be able to predict values of your dependent variable. And this is the simplest thing. All you're just doing is what? When you have your regression equation, you are just fitting in terms into it. So for example, if I have y equals to b naught plus b1 x, and they told me that what? My b naught is equals to, say, 2. My b1 is equals to, say, 5. And they say I should find the value of my y when x is, say, 10. All I just need to do is what? Input these values into the regression equation and calculate the value of my y, right? So that is the simplest question you can get. But what you should be careful for is what? The pitfall. Yeah. And the pitfall is always that what? If your regression model has a different functional form, if it's not a linear function, so y equals to b naught plus b1x is a linear regression. But what if you have something that says ln y equals to b naught plus b1 ln x? This is a log form. So the pitfall here is that what? When you are doing your prediction, you have to take note that you can't just impute your x value. You have to first convert your x value into a log term before you impute it into the equation. Then when you calculate the value, that value is not your y. You have to now find what? The exponential of it to convert it back to your y. So that is the pitfall you need to watch out for when doing prediction, right? One of also the important things they can ask you is to build a confidence interval around your words, your predicted y value. And to build a confidence interval, all you are doing is what? Your predicted value, y, plus or minus what? Your test statistic, TC, times what? The standard error of the prediction. Note, this standard error is not the standard error SEE. It is what? The standard error of the prediction. Most times you will be given the value in the question. You will not be asked to calculate the standard error of the prediction itself. They will mostly give you that value. So you just need to spot it in and you do plus or minus, then you can get what? The upper and lower limits of your what? Predicted value. So like I mentioned earlier, the functional forms, you have 3 major functional forms, or what you call what? 4 major functional forms. The number one is what? The lean model. Then you can have what? A log lean model, whereby your y is in log terms and your x is in what? Linear term. Then you can also have what? The lean log model, where your y is in linear terms and your x is in what? Log term. And that will be something like this. Y equals to b naught plus ln x. So this is a lean log model, right? Then you can also have what? A log model, which is one I wrote earlier when I said ln y equals to what? B naught plus what? Ln plus B1 ln x, right? This is a what? A log-log model. So you just need to be careful about that. Then let me take you back at this point where I said that what? There must be a linear relationship in your model. To have a linear relationship, what we are saying is that what? The relationship must be linear in your B naught and B1. So even though I said ln y is equals to B naught plus B1 ln x, it's still a linear model. As opposed to this, if I wrote something that looks like this, y equals to ln, or say, if I say y equals to, say, exponential B naught plus B1 x. This is not a linear equation because what? It is not linear in B naught and B1. You have to be able to transform this into a linear equation first before you can use it, right? So please take notes. You see questions like this where they say which one is a linear equation, right? Okay, so that's a brief rundown on the first reading. And another thing I first mention is what? The null hypothesis for when you're doing your test is that what? Your B1 is equals to 0, and the alternate is that what? Your B1 is not equals to 0. This is a two-tailed test. But remember, when you are doing your F-test is always what? A one-tailed test. So you don't need to convert your degree of significance, level of significance, you don't need to divide it by 2 when you are doing what? F-test. But when you are doing T-test and you are giving a two-tailed null and you are checking it on a one-tailed table, then you have to convert it to what? Divide by 2 first before you check it on a one-tailed table. But if you are doing for F, you don't need to do any conversion. Your F is what? A one-tailed table, and you use it as just like that. All right. Next, multiple regression. The major difference between your multiple regression and your linear regression is just that what? You have more than one independent variable. Otherwise, to a large extent, your multiple regression and your linear regression are almost the same, right? Next, new thing you need to take note of is what? The functional form, where you have y. Now you have more than one slope coefficient, and this slope coefficient, B1, B2, are termed as what? Partial coefficients, right? So the same way too, we have to find what? The predicted format of it. That is what we use. We don't use the generalized form. Yeah, we use the what? The predicted form. That's what we use, right? Now we have to redefine our intercept. Our intercept is the value of your what? Dependent variable. When all the independent variables are what? 0. Then for your slope coefficient is now what? The change in the dependent variable. For a unit change in one independent variable, given that what? The remaining independent variables are what? Held constant, right? That is the difference between multiple regression and what? Linear and simple linear regression. Take note of the definition of what? The slope coefficient. Then we can do a test for each of the coefficients to test their significance. We do a t-test, just like we do in this simple regression. We use t-test for each of the coefficients using what? N minus k minus 1 degree of freedom. Now, k here is no longer 1. K is what? The number of what? Independent variables. Your p-value still works the same way. It's still the same lowest level of significance at which you what? You reject your null. Once you reject your null, any other level of significance that is greater than your p-value, you must also reject the null, right? And you also predict values in the same way. Now, let's take note of this. So I don't know if this is very clear. So if you have an output of a regression that have this, and you're asked to write out the functional form of the equation. So for this equation where they are trying to predict EG10, so EG10, the functional form rewards EG10 will be equals to what? Minus 11.6% plus 0.25 PR plus 0.14 YCS. So when you have a regression table, it will give you the outputs and it asks you to write out what the regression model. This is how you just simply write it. You just pick out the coefficients. First of all, the first one is the intercept. You know the intercept and use the coefficients for each one as what? Against the what? The independent variable, and write it out as your equation. So this is what will become your what? Your equation, right? So that's how we do it. And you can see just right after it, after each of the coefficients, you have a standard error, which is the standard error of what? Which is the standard error of each of what? The coefficients. And this is the standard error you use in calculating your what? Your t-test. Next, ANOVA and F-test. You use the F-test for the what? Overall significance of the model. Now, you see that what? We have more than one coefficient. So we will change our null hypothesis to be that what? Your null hypothesis B1 will be what? Equals to B2, equals to B3, all the way to what? Bn, depending on number of independent variables you have. And you see that what? All this value must be what? Equals to what? 0. That will be your null hypothesis. And your alternate hypothesis is that what? At least one of these coefficients is not what? Equal to what? 0. So if at least one of it is not equal to 0, then you say that what? Your model is what? Significant, and you reject the null. That means your model can predict your dependent variable, right? So we say what? Decision rule rejects null hypothesis if your F-test statistic is greater than your what? Critical value. This is saying that what? Whatever value you calculate for your F, if it is greater than your critical value that you read from your charts, then you will reject what? The null hypothesis. So we said what? The ANOVA table is simply the same thing as that for simple linear regression, the same one we looked earlier, right? Now we need to look at what? Coefficient of determination and adjusted R. The reason why we need to do this is what? Your R square for multiple regression, anytime you keep adding a new independent variable, your R square increases. So your R square, sometimes it's not the best predictor for our multiple regression. So we need to calculate what we call what? An adjusted R square. So when you have a multiple regression, what you're looking out for is what? Adjusted R square and not R square. And note, your adjusted R square is always either lower than your R square or at least equal to it. Your adjusted R square can never be greater than your what? R square itself, right? Please, let's take note of that. And your adjusted R square can also be what? Negative. So you see questions where they ask you that what? Which one is an acceptable number for adjusted R square? So don't say because it is negative. Your R square, adjusted R square can be negative. And also what? It can never be greater than what? Your R square itself. Your R square itself can never be negative. And anytime you add an independent variable that has any form of correlation with the dependent variable, your R square will always what? Increase. So these are the things you should note. Next is dummy variable. We say we use dummy variable to replace what? Non-numeric values. An example is what? I say, what are the things that affect traffic? I say either it rains or it does not rain, right? How does these two affect traffic? These are non-numeric variables. So for me to include them in my model, I'll have to find what? A numeric term for them. So I change them to what? 1 and 0. So for in this example, I will say if it rains, that will be what? 1. If it doesn't rain, no rain, that will be what? 0. So that will be the values I will use in my model. And I will now include this as part of my what? Independent variable in my model. How do you know the number of dummy variables to include in your model? This depends on what? The number of outcomes from the model, from the dummy variable itself. For example, if I say I want to know in which quarter does rain fall the highest? Question is this: how many quarters do we have in a year? That will be 4 quarters, right? So that means I can either have quarter 1, quarter 2, quarter 3, quarter 4. That means I have 4 possible outcomes. If I want to include this as a dummy variable in my equation, I will have what? 3 independent variables. 1, 2, 3. But I will not have an independent variable for the 4th one, because the 4th one is already what? Pre-specified. So the number of dummy variables you can have an equation is what? N, which is the number of possible outcomes of your dummy variable, minus what? 1, right? So in an example where we are trying to do effect of quarters on a y, on the dependent variable, the number of dummy variable we have is what? 3. So example, this will be what? Y equals to B0 plus B1 quarter 1 plus B2 quarter 2 plus B3 quarter 3, right? And this simply is intuitively, if you are in Q1, that means Q1 will be 1, then Q2 and Q3 will be 0 automatically, and Q4 will be 0 too, right? If you are in Q2, Q2 will be 1, then Q1 and Q3 and Q4 will be 0. If you are in Q4, Q1 will be 0, Q2 will be 0, and Q3 will be 0. So automatically, what you are left in the equation will be what? The value for your Q4. And that's why we say that what? Anytime you are specifying your dummy variables, it is what? N minus 1 variables you have to what? Set. So let's take note of that. Validation of regression assumptions. We know when we are setting up our regression, we mentioned some assumptions that what? There must be constant variance. There must not be correlation in the residual values. And now that we have more than one independent variable, we'll say that what? There should not be what? Relationship, a linear relationship between what? The independent variables. So these are the 3 violations of the regression model. 1, heteroscedasticity means that what? The variance is not what? Constant. The variance of the residual is not constant. Serial correlations means that what? The correlation is not, the residual values are not random. You can predict them from one another. Then the 3rd one is what? Multicollinearity, which shows that what? There is a relationship between the what? Independent variables. In the exam, what are you required to know? 1, you should know what the assumption is. 1. 2, you should know the effect of the assumption. 3, you should know how you detect the assumptions. And 4, you should know how to correct them, right? So those are the 4 things you are required to know in the exam. What the assumption is, what the effects are, how to detect it, and how to correct it. So let's look at the assumptions. So for the first one, heteroscedasticity, we say that what? It's when what? The variance is not constant. That means the variance of the residual is not what? Constant. There are 2 types. You can have conditional heteroscedasticity or what? Unconditional heteroscedasticity. For conditional heteroscedasticity, so first let's talk about unconditional. Unconditional means that what? The change in the variance is not directly linked to what? Your independent variable. So for our level, we don't worry ourselves with that. What we are concerned about is what? Conditional heteroscedasticity, where the change in the variance is linked to what? To the level of what? Independent variable. So the one we are worried about is what? Conditional. So now we've done what it is, right? That's the first part. Next is what? What is the effect? The effect of heteroscedasticity is that what? Your standard errors are what? Unreliable. They become unreliable. Your coefficients are not affected. So what is the effect of this? If your standard error is too small, that means your t-stat will be what? Too large. And that means you will be rejecting your null hypothesis when you're not supposed to reject it. And that is what we call what? A type 1 error, rejecting a true null when you're not supposed to reject it. That is what? Your type 1 error. Then the fourth effect is that what? Your F test becomes what? Unreliable. Remember, your F is calculated as what? F is what? MSR over what? MSE. And when we say that what? When your error is unreliable, that means your F test too will become what? Unreliable. Next is what? How do you detect it? One, you can do a scatter plot of your dependent variable against your independent variable. So you have something that looks like this. If I do a scatter plot and I have my regression line and I see something that looks like this, I see where things are clustered around, then at a point they become scattered. Because it's widening, I will say that what? My variance is not constant. This is what I should have normally. Typically, this is what you should have. Your values should be what? Have the same level of clustering around your what? Predicted equation line. But if at some point they are close and at some point they are loosely packed, you say that what? The variance is not what? Is not constant. Also, you can also do what we call what? A Bruch-Pagan test, which is what? You calculate NR squared and you compare this to the chi-square. Once this value is greater than your chi-square, you say that what? There is evidence of what? Heteroscedasticity, right? Those are the things you need to note. How do you correct it? You can either use what you call what? Robust standard error or what? White corrected standard error. Or two, you can use generalized least square method. So those are the things you need to know. And how do you apply robust error? So when they give you a regression output and they tell you that what? There is evidence of what? Heteroscedasticity. All you need to do is what? Look for the value of the one corrected and use it to recalculate your t statistic. So for example, if I calculated my t statistic as what? B1 minus B theoretical divided by what? Standard error. So this is my initial standard error. All I need to do is what? Replace this standard error with what? The white corrected standard error and recalculate my t statistic. Then I'll now redo the test and see if it's still significant or not, right? That is for what? Heteroscedasticity. The next assumption is what? Serial correlation. We said that what? First thing is that what? What does it mean? It says that what? The residual terms are correlated with one another, or they can be correlated with what? The independent variable. So you can predict them by just looking at the independent variable, right? There are two types, positive and negative. Positive means that what? When the error is increasing, it will always keep increasing. Then when it's falling, it will always keep falling, right? So you can see a pattern that, oh, it's going up here, it's coming down here. That is what? Positive serial correlation. The negative is that what? You can see something that looks like this. It goes up, it comes down, it goes up, it comes down, it goes up, it comes down, it goes up, it comes down. Right? That is what? Negative serial correlation. We are not concerned with negative serial correlation because it nullifies itself at the end of the day. But we are concerned with positive because this is very what? Peculiar with real life data, especially in the finance industry where you measure returns and all that. Most of the data you see there are what? Mostly have positive serial correlation. So we are concerned with what? Positive serial correlation. What are the effects of positive serial correlation? Standard error are usually very small. The coefficients are unaffected. T-tests are too large. This leads to what? Type 1 error. Then F-tests are what? Unreliable. And you can see that what? There is so much similarity between the effect of serial correlation and the effect of what? Heteroscedasticity. And they are very similar, right? And this also shows in how you correct them. They have similar approaches to correcting them too, right? How do you detect them? You can do a residual plot. So you plot your error terms against your what? Independent variable. And if it shows a pattern of serial correlation, then you say that what it exists. Next is what you can do a Dobbin-Watson test, right? How do you do Dobbin-Watson test? We say that what the formula is what Dobbin-Watson is what 2 into what 1 minus R, where R is your correlation coefficient. So let's take an example where R is very strong, where the correlation is very strong, and say R to 1. Then this value becomes what? This value becomes what? When R is 1, this value becomes what? 0, right? Then when R is 0, this value becomes what? 2. Thank you, Chamaka. Right? So we can see that what? When we calculate our Dobbin-Watson and the value is close to 0, that means that what? There is positive serial correlation. And when the value is close to what? 2, there is no evidence of positive serial correlation, right? And that's how you do your interpretation. Sorry, I saw somebody ask a question that which is better between when we are checking. You are looking for the one with the greater F. That's what we use. And question just skipped by now, right? I think I missed it earlier. You are looking at the one that has a greater F when you are comparing two models, right? So back here. So normally, typically in the exam, what they will give you is this. They will give you a Dobbin-Watson scale. A scale for Dobbin-Watson. And you have the lower value and what's the upper value. Then they'll give you a value from the regression analysis. So let's say, for example, in this example, in this my scale, let's say my lower value is 1.4 and my upper value is 1.6. And they give me a value, say 1.8. All I need to do is what? Put the 1.8 on this scale. So this is how we interpret it. In these three scales, this is how I interpret it. The closer to 2 will be what? When it's closer to 2, means that what? There is no correlation, right? No positive correlation, right? No positive correlation. When it's very far off from 2, when it's below the lower DW, you see that what? There is positive correlation, right? When it lies between the lower and the upper boundary of your DW, you said that what? It is inconclusive. You cannot tell if there is positive or there is no positive correlation, right? So it's what? Inconclusive. So those are the things you have to look out for, right? Then, how do you correct for serial correlation? One, you do what? You can adjust your coefficient using what? Ansing method. Or two, we can what? Improve your model specification. Also, you can do a combination of White-Ansing method, right? Because I said here that what? You can see the effects for correlation and the effect of heteroscedasticity. They look the same. So you can actually have a combination of what? White and Ansing. They can give you that. But note, when you are using White and Ansing, it is when you see that what? There is heteroscedasticity present too. But when what you have is just serial correlation alone, you should use what? Ansing alone. But when you have a question that has both heteroscedasticity and it has autocorrelation, or what you call serial correlation, you can use a combination of what? White Ansing, right? The third one is what? Multicollinearity. Okay, so David is asking, OTIC is negative 2. So like I said, all we are dealing ourselves with is what? Positive serial correlation, right? When R is between what? 0 and 1. We are not looking at negative correlation, right? It's only positive. So the only test you do is for what? Positive correlation. That's the only thing you're looking out for. So you cannot get negative 2. So multicollinearity, we said that what? What's the definition? That what? The independent variables are what? Correlated. What is the effect? Your coefficient becomes what? unreliable. And what? The standard error becomes what? Too large. Then what? This test becomes what? Too small. This thereby leads to what? Type 2 error. Then we said that what? How do you detect it? One is this. Your F tests may be significant, whereas none of your T test is significant. Right? If you have a significant F test, but all of your T tests are not significant, that can indicate multicollinearity. Also, if your R square is very large, that can indicate multicollinearity. Also, if you have high correlation between the independent variables, so if they gave you the correlation matrix for the independent variables, and you see that what they have high correlation, that can suggest that what a possibility of what multicollinearity. How do you correct it? Simply, what do? You omit one or more variables, right? So imagine I'm trying to do a prediction of performance of stocks in the Nigerian stock market, and I put, say, the 5 top banks into the model. What I'm saying is this: those top 5 banks are driven by the same economic factors. There is no point putting the 5 of them in this model. What I should do for is what? Remove 4 of them and just leave only one, and use that one as the representative of the whole banking sector. That's what we are saying, that omit the other variables and just keep one out of it, right? So which one is more serious between heteroscedasticity and serial correlation? So it depends on what the actual reason. Like we said, serial correlation is a real life problem, right? With returns and everything. And you can see that what in real life, you know that when there's a period of boom and there is high return, there's always high return. And when there's a recession, there's always poor performance, right? So it's not about which one is, it's if the two exist at the same time. That was either one, if either one exists in your model, you have to correct for it. The bigger problem is if the two exist at the same time. That's what the bigger problem is itself. I would think it would be heteroscedasticity, because heteroscedasticity can come in different forms. Serial correlation can only come in one form. It's usually the positive one you're worried about. But heteroscedasticity, you can have your standard error can be too small or your standard error can be too large. But in serial correlation, it's just one part. Your standard error is just usually small, right? That is it. But heteroscedasticity can have either of the two. Either it's too small or it's too large. So I would think it's heteroscedasticity, but I'm not sure certain about that. But I would think it's heteroscedasticity. Now, let's go back to model specification. When you specify your model, what are the things that can be wrong when you specify your model? Right? Sorry, please. Okay. When you specify your model, what are the things that can be wrong? One, you can have what? You might have omitted important variables. Or you might have failed to transform your variable. Or you collected what? Wrong data. Also, you might have used a large dependent variable as your independent variable. So you are using the previous value as your independent variable. That will affect your linear regression. Or you are predicting the past. That means you are using a function of the dependent variable to predict that same independent variable. An example is this. If I want to know how market cap affects returns, then for a particular month, I chose the market cap at the end of the month. What we are saying is that what? The market cap at the end of the month is already has the returns for that month inbuilt into it. So if you use the market cap at the end of the month, that means you're just using the same thing to predict itself. What you should use is what? The market cap at the beginning of the month, right? As opposed to what? Using the market cap at the end of the month, right? So you're not predicting itself. That's what we are saying. So you're not forecasting the past. Then the next one is what? If you have what? Measure your independent variables with what? Error. So these are just a garbage in, garbage out error. Then you can also have other time series specification that could include what? Non-stationarity or instability of your what? Coefficients. So those are the kind of specification you can have. So let's go to the third reading, which is what? Time series. So in time series, now our independent variable is what? The only difference here is that what? Our independent variable becomes what? Time, right? Our independent variable becomes time. But then every other functional form remains the same. But now there's a peculiar problem when you do a regression against time. We know with time, things always what? Tends to what? Repeat themselves, right? For example, we know when rain falls, usually in the year, right? And we know that what? For that same period, the rain will continue falling year on year, year on year, year on year. The problem with this is that what? With time series, you can develop what you have what? A pattern. And once your model have your dependent variable has a pattern with time, then there's a problem already because you keep carrying that pattern over and over. So we have to find a way to what? Address the issue of what? Pattern in our time series. Your time series has, it can either be a log time series, a log, or a linear log. What informs your decision? If you have the rate of change as in absolute amounts, so if I say, if let's say, for example, in year 1, sales is 100, then year 2, sales is what? 110. Year 3, sales is what? 120. Yeah, you can use what? A linear model. But if your rate of change is in a percentage or is in a rate itself, let's say, for example, in year 1, it's 100. Then in year 2, it increases by 10% to 110. Then in year 3, it increases by 10% to 121. Now you can see that what? The change here is by what? Percentages, 10%. But here, the change is in what? Absolute term, 10. When you have a rate of change in percentages, you should use what? A log, the log form, log functional form, right? But if you have the change in what? Absolute form, then you should use your what? Your linear form. Those are the things that affect the model, the functional form of your what? Time series. What are the limitations of time series trends? Like we said, because things are always repeating itself. One of the limitations is what? Autocorrelation. The error terms seems to be able to what? Follow a pattern. They follow a pattern, right? And we have to what? Be able to address that. One of the ways we address it is what? To use what? An autoregressive model. What is an autoregressive model? We say that what? We'll regress the dependent variable against what? A lagged variable. What do we mean by a lagged variable? A lagged variable is just simply what? The value of the dependent variable in the preceding period. So if I have, I will say y1, y2, y3, y4. Then I want to predict. I will say y4 against y3. So this will be the independent variable, y3. And when I have y3 here, I will have y2 here. When I have y2 here, I will have what? y1 here. You can see immediately I did the autoregressive transformation, right? I had 4 variables here. I ended up with what? How many variables here? 3. So immediately I lost 1 variable. So when you're doing an autoregressive model, especially an autoregressive model 1, if you're doing autoregressive model 1, automatically you will lose what? One variable. So if your n initially was what? 60, you will end up with what? N as what? 59. So please take note of that when you're doing autoregressive. One, when you're regressing against one lagged period. So please, let's take note of that. Right, and this is the functional form of your what? Autoregressive model. You can see xt equals what? B0 plus B1 xt minus 1. Where xt minus 1 is the preceding period. And you can see we still have the same way we'll have added in linear regression, and every other thing we do from there is just the same. We say that what? For an AR model to be valid, the time series must be what? Covariance stationary. What do we mean that a time series is covariance stationary? One, we say that what? It must have what? A constant and finite expected value. Constant means that what? It doesn't change. Finite means that what? It exists, right? So your expected value must be what? Constant and finite. Your variance must be constant and finite. And your covariance too must also be what? Constant and finite, right? That's what you mean by what? It is what? Covariance stationary. Then your AR model can come in what? In different orders. So for example, if I have an AR1 model, that means that what? It has one lagged variable. So it has just one what? Independent variable. And that independent variable is what? The immediate lagged period. I can have an AR2 model. An AR2 model, we have what? Two lagged periods variable. And it will have what? Two independent variable, and so on. So that's how you determine the number of what? The appropriateness of your model, if it's AR1 or AR2. When you want to forecast with an AR model, as opposed to when you forecast from ordinary regression, when you're forecasting for ordinary regression, all you just do is what? If I have Y, if I have Y equals to B0 plus B1 X1, right? If I want to forecast for when X is 1, all I just need to do is what? Change this X to 1. If I want to forecast when X is 2, all I just need to do is what? Change X to 2, and I'll predict for Y. But for AR model, you can't just simply do like that. If AR model, if I want to forecast for, so now we know that for AR model, our X here will be what? A function of what? Time. So if I want to forecast for when time is 1 and when time is 2. So if I want to forecast for when time is 2, and we have to first of all forecast for what? When time is 1 first. And that value I get, I will now use it to forecast for what? When time is 2. And that's what we call what? The chain rule of what? Forecasting. It says that what? You forecast one period before you can forecast this 2 period ahead. And this is an example. Here we are forecasting what? We want to forecast xt plus 2 when time is xt plus 2. But before I can forecast when time is xt plus 2, I have to first of all forecast what? When time is what? Xt plus 1. So I will do x at t plus 1 will be equals to what? B0 plus x at t. So when I get this value for x at t plus 1, I will now use it to predict x at t plus 2, which will be what? Xt plus 2 will be what? B0 plus B1 xt plus 1. The xt plus 1, which I predicted here initially, is what I will now carry. You can see something already. If there is any error in this first part I predicted, that means I will carry that error into the second one, right? So you can see that what? You can have carryover error when you are doing what? Forecasting in time series. So please, let's take note of that. When you're doing autocorrelation and what? T-test. So if you want to check if there is correlation in the time series, it says you will test for autocorrelation of the residual for any significantly that's what different from what? 0. We check if any of the coefficient is significantly different from 0. You say what? You use t-test. Here, the standard error you are going to use for your t-test is what? 1 divided by what? Square root of what? T. Where t is what? The number of observations. So when you are doing autocorrelations, even if you have 5 residuals, all the autocorrelations will have the same what? Standard error estimate, right? Because it's all calculated as what? 1 divided by what? Square root of t. And t is what? The number of what? Observations. Next is what? Mean reversion. What do we mean by mean reversion? Mean reversion means that what? The tendency that what? The value will move what? Towards the mean. So what it means is that what? When you have a value that is greater than your mean, you will expect that what? It should come down all the way till it gets to its mean. And when you have a value that is lower than the mean, you should expect that what? It should go up all the way to its mean. That is what we call what? Mean reversion. And to know the mean reverting level is simply what? Your B naught divided by what? 1 minus B1. That is what? Your mean reverting level. So anytime your X is greater than your mean reverting level, you expect to predict what? A lower value. And anytime your X is below your mean reverting level, you expect to what? Predict a what? Higher level. Note, your B1 must be what? The magnitude of your B1, the absolute value must be what? Less than 1. For you to have what? A mean reverting level. If the absolute value is not less than 1, you cannot have a mean reverting level. Right? The absolute value of B minus of B1 must be what? Less than 1 for you to have a what? Mean reverting level. Please take note of that. Then we have what? In sample and out of sample forecast. In sample is that what? Is you are forecasting within the same test sample you use or the sample you use. Then out of sample is what? You are using a different data to test your model. So if I have two data, data 1, data 2, if I carry out my test here and I predicted my model here, right? And I use that same model to test the accuracy within this same model, let's say model 1, model 2. That is what? In sample test. If I now carry that model and take it to sample 2, that is what? Out of sample testing, right? How do you know which of your model is good? You use the one that have what? The lower root mean squared error in out of sample data, right? That is the one you use, right? So when you're testing for your model, you are looking at what? The one that has what? The lower root mean squared error in out of sample data. Instability of coefficients. What we mean by instability of coefficients is that what? Your coefficients can change over time. And what causes this is what? When you have changing economic values or when you're pulling data from the range that is too large, right? You can have what? Instability of coefficients. Random walk. When we say random walk, we say that what? The predicted value is what? Equals what? The previous value plus what? An error term. That means what? The best predictor of your next term is what? The current term plus what? An error. Sorry, Muhyiddin, I don't understand the question. So if you ask the question better. So when we're doing random walk, we expect what? The expected value of the error term to be what? 0, right? So because there should not be any error at the end of the day. So the expected value should be what? 0. You have constant variance of the error term, and the covariance of the error term should be what? 0. When we say covariance of the error term to be 0, we are saying that what? The error term should not be what? Related to one another, right? All random walk are not what? Covariance stationary. What does this mean? You can have two types of random walk with a drift and random walk without a drift. Random walk with a drift means that what? Your B naught value can change, it's not 0, right? And random walk without a drift means that what? Your B naught is what? Is 0. But any data that has what? Exhibits random walk cannot be what? Covariance stationary, because what? B1 is always equal to what? 1. When you have random walk, your B1 is always equal to what? 1. What you call what? A unit root. If you have a unit root, you are supposed to transform your data before you can use what? AR model. To test if your data has a unit root, you use what they call what? A Dick-Fuller model. And Dick-Fuller tests for what? The null hypothesis are what? B1 minus 1 equals to 0. Or you can say B1 is called what? G. And you test for what? If G is equals to 0. Right? And that's how you test for your Dick-Fuller. If B1 minus 1 is equals to 0, if you don't reject the null, that means that what? You are saying that what? There is unit roots. If you reject it, you are saying that what? There is no unit roots. That's how you check if there is unit root. How do you transform? You transform using what we call what? First differencing. When you use first differencing, what we are just simply doing is what? You are plotting the error terms between two predicted values against its previous error term. So what we are plotting is what? YT, where YT is what? XT minus what? XT minus 1. So it's just this error term I'm predicting. Note, I said that what? When you are doing AR model, right, you lose one variable. When you are using first differencing, you will lose another variable again. So if you transform from a time series and you use first differencing, if you started with what? 20 variables, you are going to end up with what? 18 variables. When you're calculating SC in autocorrection, no, it's 1 minus what? Square root of T. That's how you calculate the value of your what? Standard error, right? Please, and it's in the curriculum. Right? So, like I said, if you are using first differencing, if you started with what? 20 variables, you will lose 2 variables, and you end up with what? 18. When you're doing first differencing, at the end of the day, because you said that what? Your error term must have what? An expected value of 0. So your B0 is expected to be equal to what? B1 is expected to be equal to what? 0. And this should be what? Covariance what? Stationary, because you have what? B0 into 1 minus B1, where B0 is 0 and 1 minus B1 will be equal to what? 1. So 0 divided by 1 is 0. It is finite and it is what? Constant, right? Please, let's take note of that. Seasonality, because we said that what? Things always repeat with time. You always see pattern, and that's what seasonality shows. Question is this: when you see seasonality showing, all you have to do is what? Account for it and bring in the factor of your seasonality and add it to what? Your model. And this I have here, I know it's small, is an example of what? An AR model what? With a seasonal lag. So you've done an AR model, you now show that what? There is a seasonal lag. All you need to do is what? Your model, add an extra independent variable to it, which what? Accounts for your what? Season, right? Note, even though we have 2 independent variables here, this is still an AR1 model, because it's just what? An AR1 model with what? A seasonal lag. This is different from an AR2 model. AR2 model will have been what? XT minus 1, XT minus 2, right? But this is just what? We're accounting for what? A seasonal lag. Please, let's take note of that. When you're forecasting with an AR model with seasonal lag, just have to be careful that when you're saying there is a seasonal lag, what we are saying is this. If you're predicting a value for now, time t, you're saying that what? T is not only affected by what? T minus 1, which is the previous time. It's also affected by what? The value of t in the previous what? Year. Do you understand? That's what we are saying, that when we are testing for seasonality, if you see seasonality existing, we are saying that what? T is not only affected by its previous value, right? It is also affected by what? The same value of t in the previous year, which is why we have to bring in the value for what? The seasonality there. Then auto-regressive conditional heteroscedasticity is used to test for what? Variance of residuals in a period, that you can use what? Variance in one period to predict variance in another period. So you say that what? There is what? Auto-regressive what? Conditional heteroscedasticity, right? The same heteroscedasticity we mentioned in multiple regression, right? So we use what? This ARC model to test for it. So what we have is what? We will predict the variance of the error term using what the variance in a previous term. And if the coefficient is significantly different from 0, we say that what? There is what? Heteroscedasticity is present, right? Now, non-stationarity and co-integration. Before you can use your linear regression model, there must be what? Stationarity. Your coefficient must be what? Covariance stationary. Or if there is not stationary, now before you can use your model, you have to check the tests. That means if you're having multiple regression, if you're having testing for more than one time series, if you're testing one time series against another, you have to check if they are both stationary before you can use them. One, if they are both stationary, then you can use them. You can go ahead and use your model. If one of the model is not stationary, either the dependent variable or the independent variable is not stationary, then you cannot use the model. You have to first of all go and correct it first. If neither of the model or the time series is covariance stationary, if neither is covariance stationary, then you have to do another check. If they are co-integrated, then you can go ahead and use your time series model or your regression or your AR model to solve it. If they are not co-integrated, then you cannot solve it. You have to first of all what? Do a transformation. Question is what? What do we mean by what? Co-integrated. They are saying that what? They are driven by what? The same economic factors, that their variances are the same. That's what we mean by what? Co-integration. Next is machine learning. So let's just do a quick rundown on machine learning. Just machine learning, what you just need to know in machine learning is what? The types of machine learning you can have. You can have either supervised or what? Unsupervised. In supervised, you have what? A target variable, and you have what? A training data. Training data is just like having a sample. Target variable is your what? Dependent variable, right? Then in unsupervised, you don't have a training data and you don't have a target variable. All you're just doing is what? You are giving your algorithm, your model, a set of features, or what you call what? Independent variable. And your machine is going to look at it and throw out the best possible relationship that it can find, right? You have majorly two types of variables. You can have what? Continuous variable or categorical variable. Continuous usually speaks to what? Numeric values, right? Where categorical speaks to what? Text, image, and all that. So like I just defined what target variable is. It says the dependent variable features are what? Independent variable. Your training data is what? Your sample data. Hyperparameter is what? A parameter or an input specified by the researcher itself, right? If you specify a parameter like a dummy variable, for example, it becomes what? An hyperparameter. Overfitting. Overfitting exists when you have too many features or too many independent variables. It gives you what? A false sense of the predicting power of your what? Model. It makes you think that what your model can predict, whereas your model is just being able to predict within the in sample alone. When you take your model into an out sample, right, you will see that what? The error will become bigger. So that's what overfitting does. How well do your model generalize? You want to know how well your model works. First is what? You first of all you divide, if you have a data set, divide into 3. First one, you call it what? Your training sample. That's what you use to generate your what? Initial model, right? When you have your initial model, then you improve, you now take that initial model, take it to the next sample, which is what you call what? Your validating sample. Then you use that to fine tune it, use it to correct for any noticeable error. Then after you've not done that, you now take it to what? To the test sample. That test sample will not be your what? Like your final sample you are used to validate to now see that what? To test the predicting power of your data. And this is what? This test sample will be on what? An out of sample test, right? Because it's not part of the data you used in what? In generating your model, right? This test sample. Sorry. Then the type of error you can have a bias error. If you have a what? A model with poor fits. So the model you get from your sample itself, right? You can have a bias error. That is error from what? From your test sample itself. Then you can have variance error. This is what? From what? Overfitted error. So when you use the model you thought you've done, if you now use it in another sample, like the validating sample or an out of sample data, then the error it gives you is called what? A variance error. Then the residual error, as different from bias and variance error, is called what? The base error, which is the normally expected error. And this chart is in Schweizer, where you can see the types of algorithms you have. So you say you can have either supervised or unsupervised. You can have variables. Your variables can either be continuous or categorical. You can see. So if you have a supervised and continuous variable, it says you can use regression, you can use penalized regression, you can use lasso, you can use logistic, you can use CAT, and you can use random forest, right? But if it's classified, maybe we have what's it called? Categorical data. So you use classification, logit, you can use support vector machine, which is called SVM. You can use k-nearest. You can also use CAT. You can see that you can use CAT in both. Another advantage of CAT is that CAT avoids what you call black box. CAT lets you see what is going on in the data, right? So CAT has major usage. Then you can have unsupervised algorithm where you don't have any target variable, right? That you can use what? If you have continuous, you can use principal component analysis, whereby you're trying to check which of the features are much more important, so you can choose the best. Or you can also use clustering. One is k-means. K-means is that you separate all your features or your data into specified number of cluster. Then you can use hierarchical. Hierarchical is different from k-means in saying that in hierarchical, you don't have the number of clusters right from the beginning. You just keep adding variables to each other. The ones that are similar to each other, you keep adding them till you get to the end, right? But in k-means, you already have the number of specified clusters right from the onset. And you also use the same things for categorical. Then in neural networks is what we're all familiar with when we say that, the machine can process information a lot, right? We use deep learning, whereby the machine just keep checking, and just trying to find the best pattern. Then in reinforcement learning, where the machine keeps learning from itself, the machine gives you an output, then it tests for the output itself, then it improves on the output. And that's what we call reinforcement learning, right? So those ones are things you just have to read, right? And what I advise people is when you're doing machine learning, because some of us are not familiar with this field, when you see anything under machine learning that you're not familiar with, just go and check for the English interpretation of that word, right? For some example, you can see something that says parsimorous, and you're asking that what does it mean? Just go and check for the English, which means that to reduce something, right? And that will give you an idea of what they are trying to talk about. Then in big data, all you need in big data is know the steps. One, you conceptualize, that means you develop your model task, you set an objective. Next, you collect your data. Then you prepare your data, preparation and data and wrangling. Then you explore your data and try and see how you can make it more better. Then you do model training. So in data, you can have either categorical or continuous data. That means numeric and non-numeric, right? So whatever you do for numeric is the same thing you do for non-numeric, or what you call text data. The only thing is just that you just have to make adjustments for text, right? That's just the only thing. You have to clean text and make sure that you take out noise and everything away from text. So part of the things you do is data cleansing. In data cleansing, you remove missing values, you remove invalid values, inaccurate values, non-uniform values, or duplicate values. Then in data wrangling, you do what we call transformation and scaling. In transformation, you can either extract, aggregate, or filter, or select data, the features that you want, right? In scaling, you can either normalize or standardize. Then for text, when you are cleansing text, what you are removing is you remove HTML tags, because if you downloaded your data from online, you might have links, embedded links in it, right? Hyperlinks, so you have to remove them. If you have punctuations, like full stop, comma, you have to remove them. If you have numbers, you have to remove numbers, except you need the number itself, right? So for example, if I'm doing text and I see the number 7 in it, I don't need it. But if I actually need the number 7 to show, like I say, for example, mile 12, I need that 12 to show. So I will leave it there. Like that's what we are saying. But if it's that just 12 is just a random number, you have to take it out. Then any white spaces like tabs and indents, you take them out. Then in processing, what we are doing is what? We are doing lowercasing. Lowercasing is that what? You want to separate the difference between, if you have capital letters and small letter. If I spell like my name in capital letter and I spell my name in small letter, what does it mean? Is there any difference in the two? No. So I will do lowercasing and change all my data to what? Small cases. Then you have what? Remove stop words. Stop words are words like D, A, and those things like prepositions and code. They just appear a lot in your data and they can what? Distort your data. So you have to do what? Take them out. Then you have what you call what? Stemming. Stemming is that what? When you have a word appearing in different forms, like run, running away, run, all those things, there's still a form of run, right? You have to what? Replace them with a single word, right? Then lemmatization is that what? There are words that have similar meaning and they have a root. Root means that what? The original form of that word. So you can see that what? Stemming and lemmatization are not so different from each other. But just that lemmatization is that what? You are using the original roots of that word as its meaning, right? Tokenization is the way you convert sentences to tokens. Tokens is what you now use in your data. Bag of words is just collect all words or tokens together and you can show it. It looks like something that looks like this. Like this, and you will see the words. The ones that appear big are the ones that appear frequently, right? Documents term matrix is used to convert what? Unstructured data to structured data. You cannot do any analysis if you don't convert your data into a structured data first. So you use a document term matrix to convert all your data to what? N-gram means what? The number of words that are in your token. So for example, if I have president, this is what? A monogram, right? But if I have something like the president, and I want this thing to always be showing at the same time, every time, the president, I want it to always show at the same time. Or I have something like what? United States of America. So instead of it separating it into United States and America, right? I want it that anytime you see United States of America, pick it as one single word. And that would be what? If there are 4 grams, that would be a what? Whether quarts, gram or something, right? That would be a 4 gram, right? How many number of letters is making your token, right? That's what you call what? N-gram. Then data exploration. How you make your data better. You can do principal component analysis. We already said that in machine learning that you pick the most important data. You can do feature selection. You can pick the best feature or the best independent variable, right? The lower the number of your variables, the better. Then you can do feature engineering, whereby you can transform or re-engineer your data. Then model training. I want us to get, I'm trying to rush it so I can get to solve some questions. How do you train your model, right? You check for method selection, you do performance evaluation, and then you tune it. What are the types of performance evaluation you do? You can do precision, recall, you can check for accuracy, FI score. FI score is always very important. FI score is the best way to check for what? Your model performance, especially when you have what? A non-symmetric data, right? Where one data type is more than the other. The best thing to use is what? FI score. You can also use what? Receiver operating characteristics, which measures your what? Your true positive rates and what? Your false positive rates, right? And you can see the formula. You should, hopefully we'll see an example to get through. The third way you can measure your performance is what? Using root mean squared error, right? And we say when you're using root mean squared error, what we always do is what? We choose the one with what? The lower root mean squared error. That is the one we choose. When you're dealing with balanced data, you can use either one, right? You can use either accuracy or F1 score. But when you're dealing with an unbalanced data, you always have to use what? F1 score. was to sit down with the management. Okay, and next is questions. So let me just try and see some questions that I have and see how we can quickly run through them. So my advice for you is this: when you have questions like this in the exam, first thing you do is what? Instead of wasting your time having to read the whole paragraph, first of all, go and read your questions, then come back to the paragraph. Typically, the way it's always done is this: your questions are arranged the same way your paragraph is arranged. So it's not like they will start from first paragraph, then jump to last paragraph, then jump to the middle. No, they will keep moving, right? Hierarchically, right? From top to bottom. They won't jump. So you can just go, check your question first, then go and look for where it is in the paragraph, right? And that's what we are going to adopt here. So the first questions: Anson's description of his regression model suggests that what? The percentage change in trade deficits is best described as what? So let's go and check for that. Where did Anson describe his data? Greenberg, it says Greenberg asked Anson whether there are possible new additions to the portfolio.
You cannot see the screen.
You cannot see the screen?
Yes,
okay,
please.
Hold on.
Sir, we can't see the screen.
Okay, all right, please let me share this. Okay.
Okay.
So can you see the screen now?
Yes, please. Thank you, sir.
Okay, all right. So the question is this: Anson's description of his regression model suggests that what? The percentage change in trade deficit is best described as the what? So what we're looking for, what? Percentage change in trade deficit. What does it mean? Is it coefficient? Is it dependent variable, or is it independent variable? So we have to go and check where they mentioned it. So what did Anson says? So let's just quickly read through it. He said Laura Greenberg has just, because I'm pressed for time, as a quantitative analyst by Fortune Funds, specializes in portfolios sensitive to what? A variety of microeconomic factors. Greenberg's team leader, John Chin, has asked her to evaluate the farm's trade balance fund. The fund was constructed to perform well when the US trade deficit is increasing. Greenberg asked Anson whether there are possible new additions to the portfolio for her to investigate. He replies that what? She should evaluate the 12 stocks already in the portfolio before she tries to find new one. And she has already started doing this. Anson describes the general regression that he has prepared, stating that each explains the return performance of each security individually by the what? Percentage change in trade deficits. So he said that what? He says stating each does what? Each explains the what? The return performance of each of the security individually by what? The percentage change in trade deficit. So he's using the percentage change in trade deficit to explain what? The performance. So what is, so let's go back to the question. Question says that what? Anson's description of his regression model suggests that what? The percentage change in trade deficit is best described as what? Okay, so I have an answer. It says independent variable, and that's what the independent variable, because that's what you are using to what? Explain, right? The next question: which of Anson's reasons concerning the appropriateness of linear regression is least accurate? So they're giving us the example: non-linearity, market stability, and homoscedasticity. Let's go and look at is what Anson said, Anson's reason. He said, Anson says that what? Specifying the regression in this manner is appropriate for 3 reasons. 1, the relationship between at least one of the stocks and the trade deficit is non-linear, and using regression will normalize the result. 2, the regression errors are homoscedatic. 3, since the market has been stable and hasn't experienced any extreme events during the sample period, the relationship between the sample stock returns and performance changes in the trade deficit has been relatively constant. So which one of these is least accurate? Which one is least accurate? Non-linear, yeah, so non-linear. Before you can use regression, you have to have what? A linear relationship. Using exhibit 1, the F statistic for euro fashion is closest to what? F statistic. So let's go to exhibit 1. So this is exhibit 1. How do you calculate F statistic? F statistic is calculated as what? F statistic is calculated as what? F is what? MSR per what? MSE. Here MSR is what? RSS over K divided by what? SSE divided by what? N minus K minus 1. Here we are dealing with what? Just one independent variable, and they're giving us our what? RSS as 0.0864. So that would be what? 0.0864 divided by what? Our K is what? 1, because we have just one independent variable. All over what? SSC is 0.0656 divided by what? N minus K minus 1. Our N is given as what? 40. So that would be what? 40 minus 1 minus 1, and that would be what? 38. Right? So what's the answer? If you calculate this, what do you get? $50.05, right? So that's A. Thank you. Next question says, borderline trading's forecasted return is closest to what? So how do you calculate, how do you forecast? How do you forecast? So let's go to where the forecast is. So it says she determines the forecasted return for another stock, borderline trading, that has regression parameters. So they're giving us what? The regression parameters as what? So the forecast, let's say borderline BT equals to what? They give us our B naught as what? 2.3% plus what? Our B1 is what? Is 0.39. And they're giving us what? The value for what? Trade deficit as what? 3.22. So that's just how you calculate it. That would be what? 2.3 plus 0.39 times 3.22. So that's how you calculate it. So what's the answer? So I have 3.56. Is that correct? Okay, all right, fine, thank you. So that means the answer is what? B, right? So let's go to next question. So let me pick the next question. So this question I'm picking are some of your previous mock questions, right? I was trying to get as best the format of the exam questions as possible, right? So let's look at this next question. So like I said, we'll go to the question first. Sorry, please, what can you see? Please.
The Mole case scenario.
Okay, all right. Okay, I just want to show because I had some issues with my screen here. Okay, so this here is a typical exam question, right? You have the Demule case scenario. You are giving your coefficient outputs, right? And they're giving you your constant B naught and your P ratio, and they're giving you the coefficients, they're giving you the standard error, they're giving you the T statistic, and they're giving you what? The significance of T, right? So let's even try and understand this question, right? So that your coefficients are the coefficients. The standard error is standard error, right? We know that. Your T, how did they get this 0.935? This 0.935, how is it calculated? How did they get it? Like I said, you always test for what? When it's what? Your hypothesis is what? Equals to what? 0. So B naught is 0.143 minus 0 divided by what? 0.153, which is the what? Standard error. And that will give me what? 0.935. That's how that T is calculated. And the same thing here, this is how the T is calculated, right? So I told you that what? When you're giving a significance of T, this significance of T is the same thing as what? Your P value, right? And I said that what? The P value is what? The lowest significance level at which you reject. So that means before you can reject this null hypothesis, your level of significance must be what? At least 17.6%, right? Then this, once the level of significance is greater than 0, you will reject this, right? That is just what this table shows. And they gave you your what? R squared. They gave you your standard estimate of error, SA, and they gave you your what? W Watson. They gave you your F value, and they give you your what? Significance of F. The significance of F is also the same thing as what? P value for your what? F. Please, let's take notes of that. So let's go to the question and see what questions they ask. Question 1 says that what? The Mole statement that coefficient depicted in Exhibit 1 are consistent with random walk is most likely what? So let's go and check what is said about the coefficients. So what did he say about the coefficients? So he said that what? The Mole states that what? This regression is a special case of a first-order autoregressive model in which the value of B naught is close to 0 and the value of B1 is close to 1. This value suggests that what? The time series is a random walk. Is that correct? Is that statement correct? Yes, so that statement is correct. When you have a random walk, your B naught is usually what? Close to 0, and your B1 is what? Close to 1, right? So what Demole said was what? Correct. So the answer will be what? A, because Demole is correct. That statement is correct. Your B naught will be close to 0, and your B1 will be what? Close to 1 for random walks. Number 2, if Kamini is correct regarding the trailing PE time series, the best cost forecast of next period PE is most likely to be what? So let's go and see Kamini's statement. Let's see Kamini's statement. Kamini says that what? I am convinced the PE series based on trailing earnings is truly a random walk. If you have a random walk, how do you predict? That is what the question is saying. So what did they say? So we said that what Kamini said is the random walk, and they said, well, if he's correct, so how do you predict? He said the best forecast for next period is going to be what? A, current period trailing PE. B, forecast derived from applying ARR model as shown in Exhibit 1. C, average PE. Yes, I have the answers. Current period, A. So you use the current period to predict what the next period when you have what? Random what? Walk, right? Question 3. The results depicted in Exhibit 2 are best described as consistent with what? A regression that has ARC1 errors because of what? When you say something has ARC1 error, what are you trying to test for? You are trying to test for what? If the variances are what? Correlated. No, if there is what? Heteroscedasticity in the variances, because ACK1 is what? Autoregressive what? Conditional what? Heteroscedasticity. That's what it's testing for. Right? So let's go and check what is the. So exhibit 2. So this is the result for exhibit 2. If you want to know that ACK1 exists, what are we checking for? So they're giving us the formula. So what we're trying to check is what? They're giving us, sorry, I'm trying to, I don't know why my, so we have the formula here, they've given us the formula, right? So we can see which one is the coefficient. We know that what? C1 is the coefficient, and this is what they are regressing against each other. They are regressing error against what? T1 minus 1, and this is the coefficient. So they're giving us the, what's it called? It's the intercept coefficient and what? The slope coefficient as 2.73. If this slope is significantly different from 0, that would mean what? That ACK1 exists. So what we are checking is that what? That the intercept, the slope coefficient is what? Significantly different from what? 0. And we can see that what is significantly different from 0 because what? The significance we are giving is at what? 0. So any level of significance that is greater than 0 means that what? C1 will be significant and there will just be what? ACK1. Then we'll say ACK1 is present, right? So the answer will be what? C. That C1 is what? Significantly what? Different from what? Sorry, the answer is A, sorry. That C1 is what? Significantly different from 0. Sorry, I was calling C as A, right? So that would be the answer. That C1 is significantly what? Different from what? 0. Question 4, based on the results in exhibit 2, the Mule and Kamini should most likely model the forward P using what? So we've seen the result already, and we say that what? ACK1 exists. So how do you correct for ACK1? That's what the question is asking. How do we correct for ACK1? We use what? Generalized least square method. That's what we use to correct for ACK1. Generalized least square method. Thank you, Tumishe. Question 5. The Mule caution given in condition 1 is best described as what? So what is the caution? Let's go and check the caution. It says that what? Do you remember that when we analyze 2 time series in regression analysis, we need to ensure that what? Neither the dependent variable nor the independent variables has a unit root. Is this correct? Is that statement correct? Yes, the statement is what? Correct. Neither must have what? A unit root. So we say that what? The statement is what? Correct. Neither must have a unit root. So let's go to question 6. The Mule's caution regarding question 2 is what? Let's evaluate his second caution. That both series must have a unit root and are not co-integrated. That was not what we said. We said that what? If both series have unit roots, then they must be what? Co-integrated before you can proceed, right? If they don't have this, if they are not co-integrated, then you cannot use the time series or the AR1 model. They must be what? Co-integrated. So his statement is what? Not correct. Right? So we are clear with that. You're okay with that, right? Any question, please, if you have any question, please put it on the chat. So let's look at next set of questions. So can you see the next set of questions, please? Jordan Garfield. Can you see Jordan Garfield? How do you establish the percent of unit truth? You will do a Dick-Fuller test, testing the what? The hypothesis that what? G or is it B1 minus 1 or 1 minus B, either of the two, is what? Equals to 0. So you use a Dick-Fuller test. If you reject the null, that this value is equals to 0, that means you are saying that what? B1 is not equals to 1, right? But if you don't reject the null, that means you are saying that what? B1 is equals to 0 and the null exists, right? So you use Dick-Fuller test. It's when you're checking for what's called AC1, you want to check for if that's the coefficient is equal to 1. That's when you use Dick-Fuller and Grange tests, right? That's when you do the combination of the two. But if you're just checking for unit truth alone, you use Dick-Fuller. Okay, so can we go ahead to the question now? So we are on Jordan Garfield. So let's check Jordan Garfield. What Jordan Garfield is saying. So we have 13 minutes more. So let's look at Jordan Garfield. So Jordan Garfield is obviously on multiple regression, right? First question, the standard error of estimate of the regression model shown in Exhibit 1 is closest to what? Standard error of estimates of the regression in Exhibit 1 is closest to what? How do you calculate standard error of estimates? So where is Exhibit 1? So this is Exhibit 1. How do you calculate the standard error of estimates? So it was blank. So how do you calculate it? Standard error of estimates, SEE. SEE is what? Square root of what? Mean squared error, right? Square root of mean squared error, not SSE, mean squared error. So this is your mean squared error here. This is your mean squared error here. So you find the square root of it. So what's the answer? You find the square root of 0.003106569. Right, so what's the answer? That's 0.056. Okay, thank you. Which of Garfield's conclusion to investment committee about findings from his model is least likely correct? So let's go and look at the conclusions. So he's going to have 3 conclusions, right? Because they gave us conclusions 1, 2, 3. 1 says that what? The regression intercept is statistically significant. Is it statistically significant? Let's check. The intercept p-value is what? At 80%. So this cannot be statistically significant. Note, most times when you're not giving your level of significance, it's usually at what? 5%. So if your p-value is 80, that means what? It is not significant. So 1 is obviously wrong. 2, he said the model explains more than half of the variation in high tech. How do you know what explains variation? You look at what? Your R square, right? And the value of our R square is what? 0.54. 0.54 is definitely more than 50%, right? So that statement 2 is correct. Statement 3 says that what? The NASDAQ index return and high-tech return are positively correlated. How do you know if they are positively correlated? If you look at the regression coefficient, right, is positive. 0.18 is positive. That means they are positive correlated because that positive shows the direction. Also, if you look at your multiple R is also a positive value, right? And that shows that what? They are positively correlated. So we say that what? Which statement is wrong? It's the first statement that is wrong, right? So we have less than 9 minutes. So let's see if you can conclude on this question. So we said that what? It is statement 1 that is wrong, right? Question 3. In response to Gupta's question about predicting high-tech Garfield's prediction in decimal. So let's not deal with prediction is very easy, right? You can always deal with prediction. Let's look for much more technical question. The F statistic is what? How do you calculate F statistic? How do you calculate F statistic? It said in exhibit 2. F statistic in exhibit 2. So where is this exhibit 2? So where is the F statistic in exhibit 2? All you just need to do is what? Mean squared. That is mean squared error. This, right? Divided by what? A mean squared regression divided by what? Mean squared error, right? MSR divided by MSC. That's how you calculate the value of your what? And that is at 7.5, right? So let's look at the next question. Based on the results of the regression model in exhibit 2, the best conclusion Garfield can make about hypothesis that coefficient JPY change is 0 is to what? What best conclusion can he make? So let's look at it. What is the coefficient for JPY? So I think that is in what? Exhibit 2, right? So JPY, you can see the p-value is what? 33. That means this coefficient cannot be what? It cannot be significant. So it is not different from what? 0, right? So you accept the null, you cannot reject the null, right? Because what? It is not significantly different from 0. You can see that the p-value is 33. It is very high, right? And our total sequence is at what? 5%. So we cannot reject it. So we will what? Fail to what? Reject the null hypothesis, right? Because it cannot be different from 0. So we will fail to reject the null hypothesis. Question 6. In preparing his response to Samora's second question, Garfield most appropriately conclusion is that what? So let's go and check question 6. Do you suspect the question, the model has problems with multicollinearity or serial correlation? How do you test for multicollinearity? We say that what? When the F test is significant and none of the what? T test is significant. Here we can see that what? One of the T tests is actually significant. NASDAQ is significant and the F test is significant. So that's then we cannot say multicollinearity exists, right? Next is to test for what? Correlation. How do you test for serial correlation? Where is it? I think they already gave us a place where they gave us the W Watson value of 2.02. So if W Watson is 2.0, that means that what? There is no positive serial correlation, right? It is when W Watson is very low that you have positive serial correlation. So that means there is no multicollinearity and there is no what? Serial correlation, right? So we say that what? C does not have either multicollinearity or what? Serial correlation. Are we clear on that? So let's see if you can take maybe one before we still have 4 minutes. Let's see, we still have 4 minutes. Can you see the next question? Google mining. Yes, thanks, Muhyiddin. Okay, thank you. Okay, so this is on I think big data. Whose recollection about the preparation of textual data is most accurate with respect to what? So what did he say? What did Wu say? He said, Wu says that what she has had a little about text mining for clues about unusual behavior, and records that what text preparation must be carried out by removing what items such as what HTML, punctuation, numbers, stop words, and eliminating distinction between uppercase and lowercase. So let's check. When you are doing text preparation, what do? We remove numbers, right? When do we do stop words? It's when we are doing what? Wrangling. That is pre-processing. Lowercasing is also what? Pre-processing. So the correct one is what? Numbers, right? During text preparation, that's when we remove what? Numbers. Is that clear? Then after the cleansed textual data are normalized, the tokens added to the bag of words arising from applicant 2 are most likely to include words. So once you check which one will be the tokens, note when you have done your token, you'll have words removed. Before you generate your token, you'll have removed words, capital letter, you'll have done lowercasing, you'll have done lemnalization, right? You'll have done stemming. So I think that C cannot be correct because C has capital letter J. So I know C cannot be correct. So we are looking between A and B. So let's go and look at applicant 2. What are the words that applicant 2 used? What are the things applicant 2 says? It says, humbly stated, I am in sheer need of your kind aid. I am really needing. So he has used need and he has used needing. So needing cannot be in the answer. Can you see that? He has used need and he has used needing. So needing cannot be in the answer. So any answer that has needing will be out. He used bedroom, right? And he used really. So let's go and check the options. You have really and needing. Anyone that has really needing cannot be in the answer because you'll have removed that from what? Stemming. But bedroom was unique, kind was unique. So you can so your option is what? A. You cannot use C because help is in what? Capital letter. So you cannot use that. Question 9. Based on exhibit 2, the most appropriate statement about the model's performance for selected credit applicants is that what? It results in what? So let's look at exhibit 2. They said that what? If you look at the notes, in Quinn's notes, they said the criteria for defaulting is what? 0.6. But this loan has what? 0.41. So this loan will have been predicted to what? Not to default. So the loan has a P of what? Not to 0.41, which is lower than what? Oh, sorry, please. Which is lower than 0.6. Right? The 0.6 here. So the P of the loan is 0.41. It's lower than what? 0.6, which means that what the loan will have been what? Predicted not to default, but the loan actually defaulted. So what type of error is that? Type 2 error, right? You failed to reject a false null hypothesis, right? So that is what? A type 2 error. Then let's see if I can just say we are over time. So the last one, using exhibit 3, the most appropriate measure of accuracy for the model is what? So what is the most, what are we going to use to calculate the most appropriate measure? So let's even talk about the formula. What are we going to use? We are going to use F1 score, right? Because what? They said that what? It is imbalanced. So we are going to use F1 score. And the formula for F1 score is what? What's the formula for F1? 2PR divided by what? P plus R, right? So if you calculate that, you will get 0.86. as your answer, right? Because we have just less for time. But what you should know is that what is 2PR over P plus R, because what they said that what they use an imbalanced what data. So let me drop my contact here. My contact number is 0802-859-7562. Right? So if you have any clarification, you can reach out after the class. So sorry, I think I dropped the chat to Muhyiddin alone. So let me try and drop the chat for everyone. Everyone in the meeting. So my number is 0802-859-7562, right? So, and that's the end of it.
Thank you so much, Ibrahim. Thank you.
All right.
Thank you so much.
Yes.
Okay, guys, let's take some minute break. Then after that, we'll start equity.
We are professionals. We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietyng.org for more details. CFA Society Nigeria, making finance a force for good.
Okay, guys, good morning, good afternoon, wherever you are. So we will be doing equity, which will be the last course for this boot camp. I want to believe that you've enjoyed the first two sessions, and yes, we'll be doing this last one. This is our maiden boot camp for level 2. And I hope you guys will find it, or you have found it very interesting and helpful so far. I'll be taking you guys the equity, and after that, we will have a feedback session. We just want to hear from you guys because this is the first time we're organizing this for the level 2. So we will want to hear from you to see how best you guys feel we should organize this, or what are the things that you guys are looking for that can help you to better prepare for your exam. We at the society, we want to ensure that you guys have the best as you can to help you through your journey in CFA. And I hope after this session, the next time that I'll be seeing you guys will be probably at the boot camp for level 3. Yeah, I hope so. So after his class, please, we will need your audience for the next 30 minutes after his class so that we can have a quick feedback session, right? So yeah, we are going to be doing equity. I want to believe that you guys are well prepared. I'll quickly run through your topics and we'll do some Q&A and we will see. I will see how best you guys can prepare, how best you guys are prepared. Yesterday, we did a quiz with everyone, and like 2 or 3 of them went home with the price. So I'll see whether you guys will go with the price here today or not. All right, so let me know when you guys can see my screen. I want to start sharing now. Let me know when you guys can see. Just drop.
I can see your screen
there.
now, sir.
Good. Good one. Okay, just give me a minute. I want to be able to see what is happening there. Let's see the chart. Okay. I want to be able to see you guys' charts so that if you have any questions. So if you have any question during the course of this thing, let me know, please. Just drop me a note. I'm looking at your chart as we move along. All right, so your level 2. One of the very key things that you need to understand with CFA exams is that you have to be strategic about it. You have to know where the marks are. You have to be able to ensure that you perform well where the weights are very high. So this is how your exam is going to be set. You have 4 functional areas, and one will be ethics. The other one will be tools. That tools we have quant, economics, and FSA. The other one will be portfolio management and analysis, which will have corporate issuer and portfolio management. And the other one will be assets, which will have your equity, fixed income, derivatives, and alternative investment. And you see there are 8 things there. You see that you have like top 5 there, which is your ethics, you have FSA, you have PM, you have equity, you have fixed income. Those are your top 5. So if 4 of which should come out as 15%, that is like 60. If all the 5 should come out as 15, that means that you are 75%, right? So that means you need to be strategic when you're answering this thing. However, they're not even in one functional areas. They are spread across the 4 functional areas. So just have to do it. So now your equity. This is your equity of the headings. Your equity is divided into 3. You have equity valuation 1, you have equity valuation 2, you have equity valuation 3. But I will tell you this. In my opinion, your equity is divided into 2. 1, valuation. Whether you want to use dividend growth model, you want to use free cash flow, you want to use market-based, you want to use residual income. You need to be able to understand how to use those models to be able to value equity. That is number 1. The second one, I would say they are the theoretical part, which talks about your application and processes, your return concept. How do you calculate returns? Either through single model, which is your CAPM, or multi-factor model, which is your Farmer and French, macroeconomic model, etc. And also involves some theories on industry and company analysis. The industry and company analysis, what I would advise is ensure that you are able to interpret at least a question using POTAS 5 horses. It's a testable material, and I will not expect anything less. If the examiner, your questions will be basically in 3 areas. 1, some of them will be on how to calculate returns using multi-factor. The second one will be probably how to interpret a vintage or a scenario using POTAS 5 horses, and the rest will actually be on valuation. And your valuation will be more of all these free cash flow, H model, and dividend growth model. So those are the key things, in my opinion. And if you are able to even, if you understand all these models, then it's easier for you to be able to adopt those models in calculating or in valuing your private company. All right, so let me quickly run through these topics. Then I have some scenarios at the end of these slides, which I want you guys to solve. If you're able to solve it, someone with the highest score will actually go with something. All right, so your equity valuation, the application and processes, you need to understand what liquidation means. That is when the company is going out of business. You need to understand what going concern assumption means, which is when you expect the company to continue to foreseeable future. So, and you need to also understand what intrinsic value means, which is mainly the value that is placed on an asset, given a hypothetical complete understanding of an asset investment criteria. That is, I'm placing a value on a security because I'm a knowledgeable investor. That is what intrinsic value means. So you need to be able to understand what market price is. Market price is the price of the security that is presently trading for in the market. We also have another definition called fair value. Fair value is the price at which asset exchange between two knowledgeable investors. That is, they're able to do that. So for you to be able to value an equity, you need to be able to have selection of stocks, market expectation. You need to render a fair opinion on it. You need to be able to communicate with analysts and shareholders. So when you're also doing your valuation processes, right, there are some things you need to be careful about. That is, you need to understand where some shenanigans can happen in the financials. E.g., for revenue, there's something we call bill and hold sales. Bill and hold sales means that I'm billing my client, but the inventory are still within my control. So you need to understand from your FSA, your IFRS 15, which talk about your revenue recognition, when should they recognize that? Basically, what we are saying is that management, they have the incentive to accelerate revenue, even when the revenue has not fully occurred, and to delay expense. So you need to be able to look through the financial statement to be able to identify these gaps. That is when you can be able to do a complete valuation and have a complete understanding of the company. So what we're just saying here is that you need to understand the quality of earnings that you want to use to do the valuation. And the quality of earnings will be driven by how aggressive are they in recognizing the revenue, how aggressive are they in delaying expense and losses, what are the potential indicators that you can see or observation. They are there. So also we have all these off-balance sheet financing. You need to be able to see, we have these SPVs in the past, where organizations will go and create a company, a pseudo company, that they will be channeling their receivables to and be able to report a good financials on their main company. So, but now the standard has reversed. All these have to be consolidated with the financial statement, and proper disclosures have to be in place. You have to check the quality of the disclosure of the financials. So look at how the company is doing. What are their depreciation method? Is it in line with the industry standard, or is it too distant as compared with the industry standard? So those are the things you need to watch out for there. So I think with that, I can quickly move to your return concept. Your return concept is basically telling you how do you calculate your returns? And you need to understand some basic things. We have holding period returns. In the question, the examiner might not be that straightforward in giving you the dividend or the price. What you need to understand is that the return, your holding period return has two components. One, the dividend yield at that period, plus the price appreciation. Those are the two. And what is your dividend yield? Your dividend yield is basically your dividend over price. That's the ratio of your dividend to the price at purchase. That's your dividend yield. So the examiner might not just tell you that the dividend for the period is $2, and the examiner might say the dividend yield over the period is 2%. That means that you already have the first component of calculating your holding period returns. Then the next one is just for you to check the movement in price. That is the price at the end of the holding period minus the price at the initial period divided by the price at the initial period. whatever percentage that you get there, add it to the dividend yield that you are being given. That's your holding period returns. Those are the key or the little techniques that you need to understand here. Another thing is your realized. Your realized is when the end period is there, then you should be able to calculate what your actual returns is, right? And we also have what we call required rate of returns, which is the minimum level of expected return that you would require based on the asset risk or the opportunity cost of investing that value in another asset. So when your expected return is higher than required return, that means that that asset is undervalued. So, you know, in level 1, you must have seen that when you calculate your intrinsic value, you compare the price with the market price to see whether the market is actually overpricing it or underpricing it. That's when you can do that. But in level 2, they take it a notch further. You might not be given the intrinsic value, you might not be doing. I just said that the expected return on this asset is 10%. Calculate the required rate of returns and determine whether the asset is underpriced, overpriced, or fairly priced. So if what I'm expecting is actually higher than the level of that risk of that, that means that the asset is undervalued, and vice versa. That means that if the expected return is lower than the required rate of return, that means that the asset is what? Overvalued. So also you need to understand that your realized alpha equals to your actual holding period return that I mentioned earlier, minus your contemporary required rate of return. What I actually realize minus what is required for that asset. That is my realized alpha. Another thing you need to understand is that your expected return should equal to your required rate of return when the current price equals to the perceived value. That is, if your market price equals to your intrinsic value, that means your expected return will equal to your required rate of returns. So those are the, see, what I've discovered is that you might have read those, but there are some key things that you just need to understand and have it at the back of the mind, because when you are in the exam, you don't have the luxury of time, but there are some key things that will make you to even answer the question straightforward without doing any calculation. For example, in the question, when you say that the intrinsic value equals to the or the expected return equals to the required rate of return, and the examiner is asking you, is this asset overpriced or underpriced? You need to start calculating. It's fairly priced. You move on, right? So we also have the convergence of price. That is when you expect the rate of return. That is the required return that you earn on the asset current price and a return from the convergence of price value. So those are the two components that you have under the convergence of price. Your discount rate is what you use to discount. Your discount rate is what you use to discount all the future cash flows. Now, another thing you need to understand about all this valuation that we are doing is this. Whatever price I'm placing on a security today, or what the security is trading for in the market, simply represent the discounted value of the future benefits on that security. Check your fixed income, check your equity, your bonds, anything. What we are simply doing is we go to the future, e.g., dividend on equity, interest on fixed income, the price that is perceived, which is your terminal value, we bring it to present value. That is what I'm paying now. So if you pay now to buy a security, that pay is just like an entry point for you to be able to have access to the future benefit on that securities. That is what we are doing. So it means that your valuation is basically the discounted expectation of the future prospect of that security. That's it. So if you have that at the back of your mind, I think it will be easier for you when you see some questions as well. So internal rate of return, it is when the present value of the outflow equals to the present value of inflow. We normally call it the equilibrium rate. Yeah. So we also have our equity risk premium, which is your, this is just telling you that what is the premium that I can earn on this equity. Yeah. You must give me additional benefit for not investing the money in a risk-free asset. So that is your equity risk premium. And how do you calculate the equity risk premium? Is the beta multiplied by the what? Return on market minus your what? Risk-free. That is this high. So beta measures systemic risk. Systemic risk means that is the risk that you cannot diversify in. Then what are we doing? We are compensating you for that risk that you cannot diversify. But for risk that you can diversify, no one is going to compensate you for it. You also, what means that you have to do a diversification by yourself if you can diversify. So you must have a diverse portfolio. But for risk that cannot be diversified, which is your systemic risk, then beta is used as a compensation. Another thing you should understand is that that beta can either be asset beta or equity beta. What's the difference between the two? The first one is talking about beta that has no financial risk. And the second one, which is equity beta, is telling you that it is beta that has both financial risk and business risk. What do I mean? Any beta that you have, the beta equity has two components, which is one, business risk, the other one, financial risk. Now, both of them, if you add them together, they are the risk that is subsumed into beta. Now, if you want to get the return of a company that are not comparable in terms of financial risk, especially when you are doing valuation of private equity company, and you want to use the beta of a publicly listed company, what you need to do is you need to unlever it. Unlever means you are removing the financial risk away. When you remove the financial risk from that beta, that means that beta is called asset beta. That is an unlevered beta. You have removed it. Then that asset beta, you now relever it into the financial structure of the company that you want to use. That's what we call regearing. You are regearing back to the capital structure of the company that you want to value. Then in that case, after doing that, then you have the beta equity. That beta equity is now what you can use to calculate your what? CAPM. But if you calculate a CAPM based on beta that you have removed the financial risk, that return is only giving you a return based on the business risk of the company only. But if you use beta equity that has both the business risk and the financial risk, it means that you have calculated a return that is compensating you for both the business risk of the company and the financial risk. So those are the specific things that you need to understand there. I will not dwell too much because this is not a regular class. In fact, 6 hours cannot even finish the revision of equity. I'm just trying to be as much as concise as I can. So another thing you should understand is when we're calculating the equity returns, because when we're calculating this equity risk premium now, I said it is your return on market minus your risk-free rate. To be able to do that, you need to understand what the equity market return is, the historical. You can either calculate it via geometric mean or arithmetic mean. Geometric mean will be smaller than arithmetic mean for sure. But the point is, I don't expect the examiner to be asking you to be calculating geometric mean or arithmetic mean in the exam. You'll definitely be given the return on market. Yeah? Okay, so now, how do you calculate returns? Just like I said, basically 3 ways. Use your CAPM, which is single factor model, or use your multi-factor model, such as Farmer and French, or use a build-up method, which is your bond yield plus your risk premium. So what is your equity, your single factor is what you have flogged already, but be careful about how to calculate your beta, right? At times, the examiner might ask you to calculate what we call adjusted beta. So in that case, you can just use 2/3 of 1 adjusted beta plus 1/3 of 1. We always assume that beta is 1, right? So whether you are low that whether you are lower than 1 or higher than 1, it is dependent on the business sensitivity to markets. So that's that, and that is the estimate of the beta for non-traded company that I just explained how to use this. So your farmer and French has three. The basic one has three factors, which is your return on market minus your history. The other one is SMB, which is your small minus big factor. This one is measuring the size. We call it size factor. And the other one is high book to market portfolio return minus low book to market portfolio return. All you just need to do is just put the beta there, multiply by the factor. Yes, somebody has a question, is the adjusted beta referred to as regress beta or unadjusted beta? So it's referred to as unadjusted beta, right? But the point is, it can be, so that regress beta, it is what you are doing a regression analysis on. So if you try to get over the period, but the examiner will definitely, if the examiner wants you to do your adjusted beta, it will specify that this is your unadjusted beta there. Okay, so just put your sensitivity, which is your beta, multiplied by the factor. That is what you will have there. And we also have a macroeconomic model, which has how many history now? It has time horizon, inflation, business cycle, market timing risk. In all this, all you just need to do is ensure that you are getting the sensitivity multiplied by the factor. The sensitivity is your beta multiplied by the factor that you are going to be given in the exam. And you have your build-up method, which is your risk-free rate plus your equity risk premium plus or minus one or more discounts. So the discount will be given to you, probably discount for country risk premium or premium for country risk, you'll be given in the exam. All right, so and with that, you should be able to calculate your WACC. Your WACC is your weighted adjusted cost of capital. This formula there is what we call the ash total. What it's just saying is that the market value of your debt divided by the ratio of your market value of debt divided by the market value of the total capital in the company. Subject it to tax because there's tax benefit. There's tax benefit there, plus the ratio of the market value of equity to the total market value. So how do you select the appropriate discount rate? When you're calculating free cash flow to equity, always use return on equity. When you're calculating free cash flow to the firm, use WACC. Why? The free cash flow to the firm is used to calculate value of the firm, while the free cash flow to equity is used to calculate the value of equity. So use like for like. So when you have, when you are calculating value of equity, then use return on equity. When you are calculating value of firm, then use WACC. Also, when you have a nominal discount rate, then use it to discount nominal cash flow. When you have a real discount rate means that it's exclusive of inflation. You know your nominal discount rate equals your real rate plus inflation. So, and also just the same thing perhaps. Now see, what do you understand? Can someone just give me this? What do you think if the examiner asks you to calculate the dividend capacity of the company? What is the examiner saying there? The examiner saying what is the dividend capacity of the company? What is the examiner saying there? The examiner is asking for dividend capacity of the company. What is the examiner saying there? Yes, fantastic, James. Yes. That is the free cash flow to equity. More doing fine. Yes. Let me check this. I think I saw some questions here. This guy is saying that so build-up method does not consider beta. Yes. Which was so how do we interpret the SMB and SMB coefficient or relating them to growth and small company? Yes. So let me quickly go back here. If the examiner is asking you for small, you will have the return on small capitalized company. and the return on large cap company. The difference there is the factor. That's it. All right. So good. I can see that you guys are you are on fire. That's good. All right. So now the industry analysis or company analysis. Basically, your analysis can be top down or bottom up or hybrid. Top down means that you consider the macroeconomic environment, you scale it down to the micro, then you now do the analysis on the company history. But your bottom up is from the individual company, then you take it to the segment or the industry, then to the macroeconomic. Then you can also consider your hybrid, a combination of the two. Yeah. So when you are doing this, what we're saying is that you have to be careful when you are doing it for income statement. Check the operating cost, check the some costs that are not properly distilled, that are not properly given a complete disclosure. Your cost of goods sold to check, it should be related to the percentage of revenue. How is it growing? Is it going down or is it going up? And then also your finance expense too. Check the interest cost, check the capital structure, check the taxes. So those are the things that you need to check out when you are doing when you are reviewing the financial statement of the company. Also, look at Potter's 5 forces. Like I said, it's a testable material when you are looking at the competitive factor in an industry. What does Potter's 5 forces do? It makes you to determine the profitability of the industry. Is the industry that the company is playing in, is it profitable or not? What are the things that will help you to check it? Number one, look at threat of substitute. Do we have numerous substitute? Is the switching cost low? That is, people can easily switch from one product to the other. So does the company have what we call limited pricing power? Can they easily increase their price or not? If they cannot, can they be, I'm sure you must have read what we call inflation push price, inflation pull price, yeah. So if we have fewer substitute and the switching cost is high, that means that the company will have a greater pricing power. But if the substitutes are so many, the switching cost is low, I can move from one side to the other, their pricing power is not limited. Then another one is look at the intensity of the rivalry among the existing competitors. It will be limited if it's a fragmented industry and they have a limited growth. There is high exit barrier. That is, they cannot even leave the industry. They have to play in it because the overhead is so huge. To even leave, it will cost them money than to play. Look at the car industry. Look at the introduction of electric cars. The likes of Toyota and all those things, they didn't believe that electric cars will come up. Tesla is now one of the most valued companies in the world now because they have plants all over the world. Toyota and the rest, they cannot leave the industry. They rather improve on their existing facility to play in the industry. And that's why you now see the likes of Benz, Toyota, now all of them are now trying to bring out the electric cars. So also check out the bargaining power of suppliers. Does the supplier, do they have greater ability to increase prices? Because if they increase your price, it means that your cost of goods sold will go up. That will erode or reduce your margin. Then if they have that, what's the quality of the inputs? So if the supplier bargaining power is so high, that means the companies have a limited pricing power. So that industry might not be as profitable as it should. Then check out the bargaining power of customers too. The customers, they want high quality with low prices. So do they have a greater ability to demand for lower prices? Do they control your sales, the quality and the quantity of the product? Then you will have a pressure from them. Then the pricing power of the company in that industry should be what? Lower. And also check out for the threat of new entrant. The point is, as industry grows, players will get into the industry. Do we have barriers to entry? If the barriers to entry is high, that means that players cannot easily rush into the industry. In that case, the industry can be said to have a decent pricing power. But if it's free for all, the pricing power is eroded, then the margin will be what? Eroded. All right, so you can also check how government policies can affect Porter's 5 forces. Look at, so check your technology. Technology can change a lot of things. It can even cause what we call cannibalization. That is, it can make the existing product to be obsolete, or it can even make the existing product to be useful, but it might be negative or positive there. So check all those things in the question. So with that, I think we've reasonably covered the theory side of your curriculum. Right? So someone saying that in summary, the higher the threat, the lower the probability. Yes, that is but you have to check what the threats are, to be able to understand it. All right, so now let's quickly go to your DDM. I will not waste time on explaining all these things, but let's just go to the main point. Your DDM is just telling you that how you can use a discounted dividend valuation, that how you can use your dividend to value a company. What are the patterns that you see in the exam? One, you can see where you have a constant growth. You have your dividend, that is your D1, divided by 1 plus, divided by KE minus G. And that means that the growth is to perpetuity. You just take it up and act it. So that can be a pattern that you can see in the exam. Another one, you can see what we call a 2-stage growth, where the first stage you have high growth, the second stage then you have a reduced growth. Will this growth be sharp, dropping, or will it drop linearly, gradually? Then that is where you have the introduction of age model. All right, so the point is, when you have a visible period, you have to first of all subject them to the increase of that period, then you discount it with the returns and add it with the period that is till perpetuity. When you're calculating the period to perpetuity, that is what we call the terminal value. So when you're doing your valuation, it's basically the discounted value of the visible period, the period that you have the dividend that you can grow based on the confidence level of the growth rate, then you add it to your terminal value. That is just it. But note this, whenever you have a visible period, let's say you have for 4 years, then you forecasted for year 1, year 2, year 3, year 4. And after year 4, the examiner is now saying that the growth will be to perpetuity. When you calculate your terminal value, always use the year 4 figure to calculate your terminal value. So if the dividend is 2 in year 1, 3 in year 2, 4 in year 3, 5 in year 4, you subject all these dividend 2, 3, 4, 5 to the discount factor. You add them together. Then the 5 of year 4 is what you will now use to subject to terminal value, which will now be your DO at that point into 1 plus G divided by KE minus G. That is your terminal value using dividend growth model, right? So that value that you have, it is for value of the security from year 4 till perpetuity, till for life. However, it is that value as at year 4. It is not the value as at year 0. Remember, like I said, all your valuation is just to bring all the future benefits attributable to that security to now. That's what you are doing. But the terminal value that you are calculating, the terminal value is at the future that you have just calculated. So whatever figure you have there, you also have to subject it to discount factor of the last year, which is year 4. Then you have to discount it to year 4. Those are the petty technicalities that you need to understand there. So that's the formula that I just explained there. And that is your D1 R minus. So always watch out. If the examiner said DO means now, subject it to growth. But the examiner said next year dividend, that means that dividend has already been, growth is already considered there. Then that means that's your D1. Then you also have your Gordon's growth model to value fixed perpetual stock in that case, what you just need to do is the dividend of the perpetual preferred stock divided by the rate. That's just the formula there. That's what you just check the dividend on your fixed perpetual stock divided by your returns. That's it. Then you can also be asked to calculate the present value of growth opportunities. So if the examiner asks you to calculate the present value of growth opportunities, that's your earnings. So what we are simply saying is this. I will still go back to the basics. The value of any stock, is the present value of the future benefits. So if my earnings in year one, I discounted it by the returns, I have discounted the earnings to perpetuity. The value that I have, I will compare with the value as at today. Then, if there's a difference, that means that is the present value of the growth opportunities. Now, remember, the return of any stock, like we have said before, is basically your dividend yield or your. So let me reinterpret that or remodel that. That the returns that you're basically calculating is basically your income returns plus your growth plus your price. Income return plus price appreciation. Your price appreciation is determined by growth. If there is no growth, the price will not appreciate. So if I discounted my earnings to perpetuity and compared with the value as at today, the difference is basically the present value of my growth opportunity. And that's it. So remember, and that is just the same formula that we normally use for your fixed income. If you are valuing your fixed income, no matter the nomenclature, the basics is just the return, the interest now, plus the price that I'm getting back. And all the formulas that have been used to calculate the value of any security, they were based on that premise. That I'm going to get an income, which is your dividend, and I'm going to get the price appreciation. The price appreciation is determined or is driven by the growth. All right, another thing you need to be exactly. Your G refers to your capital gains. That's charged cost it's mobile. That is what I just want you to understand. As long as you understand that, it's easier for you to do your exam. It's just basically your dividend yield and your price return. And your price return is based on your capital gains. Exactly. All right. So another thing is you need to understand the justified PE ratio. Your justified PE ratio can either be leading or lagging. So that's your formula there for the hidden there. You know, always go back to the basics. Let your default setting be the basics. Yeah. If you look at this, what does D1 divided by E, dividend divided by earnings? What does it mean? Dividend divided by earnings. It basically means your payout. That's it. It basically means your payout ratio. So what is your justified PE ratio? It's just telling you that what the PE ratio should be based on the fundamentals. That is just justified. So if I say 1 minus B, what is your B? Your B is basically your retention. B is your retention ratio. So if I say 1 minus my retention, it means that is my payout. So in the exam, like I said again, the examiner might not say dividend in year one is this, earnings is this. It might just say that the retention rate is 40%. The required rate of return is G is this, calculate the hidden. So you need to default to the basics. So if my retention is 40, that means my payout is 60%. So that means my 0.6 should be my numerator, and my denominator will just be my KE minus G. And your trailing PE ratio will just have a G there. And that's it. And you can also use your dividend growth model to calculate your returns, which will be your D1 into your price plus G. And your D1 is your DO1 plus G. So I've explained that one. I think I've explained these 2 stages where you have I stage indication. Does justified PE ratio same as justified PE? I don't understand. That English is Does justify P is same as justify P? I don't understand. Yeah, is your fundamentals, yes. All right, so like I said, the two stage, you just have an initial high growth rate, subject it to the feasible period, calculate the terminal value to it. That means that means the high growth will sharply drop to the lower sustainable growth rate. Then if it is not going to sharply drop, that means you're going to use your H model for the second stage. So it will be your forecasted visible period, then your H model, because H model assumes that the growth will drop linearly. It will not just decline sharply. And that's that. If you have a 3-stage, subject to first growth, second growth, and your H model. And also you can use your H model to calculate your returns. That's your formula there. I can almost bet with probably 20% of my salary that you will likely see a question in the exam asking you to calculate returns using the H model. So this formula, just have it at the back of your hand. All right. So another thing you need to be aware of is your Pratt model. Remember, your growth rate, sustainable growth rate, usually your retention rate multiplied by your ROE. Usually your retention rate multiplied by your what? ROE. What we're saying is that what am I retaining? And what will be the returns on that retained investment or retained monies? That is my sustainable growth rate. That is, if I'm retaining 20% of my salary every month, where am I investing it? If I'm investing it in T-bills, which is giving me 2%, that means my growth in my money will be that retention multiplied by that earnings that I'm having. That is just the basic distance for that growth rate. So if you see net income divided by dividend divided by your net income, what is that? That is basically your retention rate. That's all. And your ROE is your cost of capital. Is your cost of capital, yeah? Or if you don't have a cost of capital in the exam or your return on equity, then the examiner might ask you to calculate net income of her sales. That is your profitability. Sales over total asset. That is your what? Assets returns. Total asset divided by your equity. That's your leverage. And that is where your Pratt model comes in. And that's it. All right. So same methodology that we have used for dividend growth is what you also use for free cash flow. It's just that free cash flow to equity or free cash flow to the firm takes what we call a controlling perspective, while dividend growth model takes what we call a minority perspective. Yeah. So free cash flow model is more accurate or more is a more representation of an estimate of the value if the company is not paying dividend, or if their dividend is very low as compared to their dividend capacity. So in the question, if the examiner say the dividend of the dividend payout is, let's say, 20% of the free cash flow. So what is the examiner telling you there of the free cash flow to equity? What's the examiner telling you there? It's basically telling you that they are paying 20% of their dividend capacity. So if you are paying 20% of your dividend capacity, if you want to value the firm, which one is more accurate? Using dividend growth model or using free cash flow? Of course, it will be using free cash flow because the company is paying only 1/5 of their capacity. All right, so those are the key things I just need to. So whenever you're calculating your free cash flow, or you want to calculate the value of the equity based on free cash flow, check it out. Are you using free cash flow to equity? Then you must use KE as a discount factor. Are you using free cash flow to firm? Then you must use WACC as a discount factor. In the question, the examiner might be asking you for the value of an equity using free cash flow to the firm. The value of an equity, look at that question. The value of an equity using free cash flow to the firm. Remember, free cash flow to the firm means that the value of the firm equity plus the value of the firm's debt. So what you need to do is when you get the value of the firm using free cash flow to the firm, then you have to subtract the value of debt from it. That's when you now get the value of equity. But if you don't do that subtraction, you will see the value of the firm in the options. It will be there. So be calm, understand the questions asked, and be able to answer properly. At this stage, yeah, I can tell you at level 2, it is more of 50% technical and also 50%, let me say, basics. Yeah. It's in level 1 that I can say is 90% of basics and 10% technical, but you are moving to the technical areas now. So it's more of 50%. When you get to level 3, then it is like 90% technical and 10% basics, right? All right, so look at this formula. It's just basically the same as the Gordon's growth. But when you're calculating your free cash flow to firm annually, you should be able to understand this formula. Net income plus non-cash item plus your interest minus tax minus fixed investment in fixed asset minus investment in working capital. But if you are starting from CFO, cash flow from operation, all you just need to do is to add back your interest and minus investment in fixed asset. Please note, why you are not considering working capital investment, because when you're calculating your CFO, your investment in working capital will have been what? Considered, i.e., movement in inventory, movement in receivables, movement in payables. All those will have been considered before you get to your what? CFO. Your movement in receivables. So let me quickly ask you this. If your receivables increased over the period, is that a source of cash or use of cash? Any fast finger? Is that a use of cash or source of cash? Fantastic. Good. Now, another thing is this that I want to tell you. The interest, you have to consider whether you are using IFRS or US GAAP. Yeah? Remember, all interest and dividend payments are considered under US GAAP. They are all considered under CFO, except one. The one is dividend paid to shareholders, which is taken to what is it called? Financing activities. Dividend paid to shareholders. But under IFRS, there is what we call flexibility. Like interest paid now, you can either consider it as CFO or consider it as investing or consider it as financing. So they're usually what we call a flexibility. So let me ask you now, if US GAAP has been used to prepare the CFO, will you still add back interest or not? Will you still add back the interest or not? Will you still add back the interest or not? If you will add back, fantastic. But if IFRS has been used and the interest was not considered, then what it means is that you don't need to add back. Yes or no? Because the interest will not have been fantastic. Yeah, and you have the formula for this thing there. So this is the IFRS. I wanted to. So can you see under IFRS, interest received can be operating or investing. Everything is, like I said, that is the way I want you just to understand it. It's easier. Under US GAAP, everything is operating except dividend paid to shareholders, which we put under financing. Every other thing under IFRS has flexibility, either operating, investing, operating, financing. So the question I just ask you now is that his thing there. All right. So whenever you're adjusting to drive if you want to calculate your operating cash flow too, what are the adjustments that you do? These are the adjustments. The depreciation expense you add back, amortization expense you add back, restructuring charge, restructuring this. All these things are the adjustments that you can do. All right, then you can also compute your FCFE. Your FCFE can be you can even start from your FCFF, that is free cash flow to the firm, into interest, into 1 plus borrowings, and it's interest tax plus net borrowing. Why do you think we are subtracting interest when we are calculating free cash flow to the firm, to equity from free cash flow to firm? Why are we subtracting interest? Why? Why are we subtracting interest? Why are we subtracting? Okay, fantastic, because the interest is for debt holders, yes. And okay. Oh, okay. So sorry, I missed this question. Mumumoide. You said, Dan, I'll hide that. Don't let me miss this again. If I miss any of your, because the question is just coming in, let me just go back. It said, please, do we consider gross investment or net of proceed when we are calculating investment in fixed assets? See, the best thing is for you, get the gross investment. Whatever is added during the period is your investment in fixed asset, because your gross minus your accumulated depreciation will give you the net. Yeah, but just check the gross asset PPE, compare with the gross for last year, then the addition will be your investment in fixed asset. All right, so these are all the formulas on how to calculate free cash flow to firm, to equity. You can either start from firm, you can start from net income, you can start from CFO, but note, always include your net borrowings. That's key there. Always include your net borrowing. And you can also start from EBITDA as well. So let me give you a simple explanation about this. What is your free cash flow? It's just the flow that is available to me. Is available to me. After my revenue, I take out the expense from there, and I take out whatever that will make me to be in business next year. That's what's available. And that's your free cash flow. And that's why we call it the dividend capacity. Because you've taken everything out and you're also provided for what to make you to be in business next year. Okay, saying that what if there is a proceed on sales and you're giving cash flow and come that? I don't understand this. Can you rephrase that so that I can understand what you're saying now? All right, so another thing is if you have, so you can also do your forecasting of free cash flow when you have a debt ratio. That's the formula that you're going to use, or just into your net income into the debt ratio into investment in fixed asset minus depreciation. More you didn't check this formula, if that is what you're trying to ask, that if you are trying to forecast when you have a debt ratio, and that's start there. So yes, let's move on. What are the issues? Other issues in free cash flow? These are just the issues. Just check it out. Adjustment of CFO, free cash flow. You cannot be complicated capital structure. You can also be confused whether you want to use free cash flow to firm or you want to use dividend. We also have the same as we have for dividend growth model, your single stage, 2 stages of growth, or 3 stages. So when you are assuming 3 stages, just assume a constant growth rate at each stage. Assume that growth rate of stage 1 and stage 3, but are declining at a stage. So all those you have to consider when you're forecasting your cash flows. All right, so the next one is your residual income, RI. This is one of the most interesting topic in your equity, and it's one of the simplest anyways, but can be complicated. So the thing is, when you're doing your residual, it's just equal to your net income and your equity charge. Whatever I have now, minus whatever I have today, my net income today, minus what I'm paying to people that provided me the capital to operate. That is what the residual is saying. What is left from my net income minus what I'm paying to my equity providers. And that's it. That's it. So that's why you can also calculate that your return on investment capital minus your effective charge minus beginning. So let me give you some formulas there. That's it there. You see that your book value. So you can either, it has two components. Number one, you must start with your current book value of equity, and number two is the present value of expected future residual income. Like I said, everything you're doing in valuation is the present value of your future income. So my residual is just my net income minus my equity charge. That's it. So, but it always assumes that clean surplus relationship exists. What do we mean? It means that earnings, dividend, so it means that I'm paying dividend from my earnings, and the rest is what I'm taking back into the business. That is, there are no, all these deferred taxes, there are some items in the balance sheet or some items that do not go through the income statement. You know, like deferred taxes, etc., all those ones, they will not allow the clean surplus relationship to what exist. So in that case, your ROE might not be a good indication of your valuation. However, it has a component that is sure, which is your book value. You know, it starts with your book value. So it has that. Now that one is very sure, which is book value. The book value, you can see it in your financials. So because your book value of equity is a representation of past performance, while your market value of equity is just a representation of future, perceived future prospect of the company by the investors. So that's that. That is your formula there. And we also have Tobin's Q, which is just saying that is the ratio of market value of debt and equity to replacement cost. And there, I would love us to really solve questions on all these things if time permits. So you can also, so in residual, there are 4 assumptions that you can make here. When you assume that residual income continues indefinitely at a positive level, that is the formula that you will use. That will be your PT, that is minus your book value divided by, that is, you're assuming that it will go on to indefinitely at positive value. But if it is, when we assume that residual income is 0 from the terminal year forward, that means your RI divided by K. That's what you are going to use to calculate the terminal value. If you assume that it declines to 0 as ROE revert to cost of equity, in that case, then that is the formula that you will choose there, which is your ET minus your RBT divided by. So there's what we call persistent factor, right? So the persistent factor to be given to you in the exam. What will make it to be low? What makes it to be high? If you assume that there's extreme accounting rate of return, extreme level of special items, those are the items that will not make your clean surplus relationship to exist. Yeah, extreme level of accounting accruals, but it can be higher if there's a low dividend payout, high historical percent factor in the industry. And the 4th one is when you assume that residual income reflects the revision of ROE to some mean level to be given to you. Then there are some strengths and weaknesses for these models. Basically, like I said, the terminal value do not make the large portion of it. The large proportion of it is the book value, which is known, but it's subject to accounting manipulations, right? Because it's earnings. You know, you are using your earnings to calculate your equity charge, right? So the earnings in the P&L, there might be a lot of shenanigans that might occur that might not make it to this thing. So, and also, like I said, the model requires clean surplus relationship to hold, or the analyst makes appropriate adjustment. So that will give you a lot of work to do there. So when is it appropriate? It's appropriate when they don't pay the dividend, when they have a negative free cash flow, when there's a deal of uncertainty, a great deal of uncertainty in the forecasting of terminal value, then you have to start with a no, and make sure that the terminal value, which form the majority of the valuation for dividend, growth model, and free cash flow, is taken away because it's uncertain, but it's a small portion or a smaller portion for residual income. So what are the items that not bypass, that commonly bypass the income statement? Those are the ones that I said did not make the the clean surplus relationship to hold, which are your foreign currency translation, your realized gains, certain pension adjustments, portion of analysis on hedging instruments, changes in revaluation surplus, certain categories of liability, change in value of some things. Yeah. So those are the things that will not make it. So if any item does not go through the income statement and just go to the balance sheet straight, then it will not make the clean surplus relationship to hold. So in practice, if you want to do RI, you have to adjust the book value of common equity. You have to check for the off-balance sheet items, discrepancy, amortization of certain intangibles, etc. And your price multiples, they are mainly your PU ratio. Sorry guys, I'm a bit fast now. Yeah, you can guys are suffering. Yeah, I'm a bit fast because I really want us to do some quiz. I have some questions at the thing there. Yeah, so your price multiples, you can base it on comparables or you can base it on forecasted fundamentals. I know somebody asked about that fundamentals earlier. Yeah, so your trailing PE ratio is your current market price divided by most recent 4 years. Your forward is your current market divided by your next year earnings. Those are the justified, this is what we talked about earlier. So you can also have a potential dilution of earnings. Yeah, these are the things that can make your price multiples not to be accurate, right? So that's it. So this is your price multiples. These are some formulas there. We've talked about this justify and forward PE ratio before. That's there. And we've talked about, so these are the type of price ratios that you can have. You can have price earnings ratio. You can have price to book value, price to sales. Their inverse is earnings yield. You can have book to market. So we have the price ratio and we have their inverses, right? And you can also have price to cash flow, which would be your CFO. You also have price to dividend, and you also have the inverse there. All right. And we've talked about present value of growth opportunity, right? As well. Yeah, I can skip here. So if you want to calculate your terminal value when you are using your price multiples, you can use as your ROE divided by G into KE minus G. It is, yeah, so these are the formulas here. If you are choosing price to sales, that is how you can calculate your perpetual value, which is your ESO multiplied by your payout multiplied by your growth. That is price to sales. If you are using it to calculate terminal value or perpetual value. Yeah, and we also have price to dividend is your RE minus G into 1 plus G. So all these formulas, you just have to calculate. Can we calculate persistent factor where it's not given? Well, it will most likely be given, but if it's not given, it will not, you will not be asked to be calculating persistent factor that is so strong. They'll just tell you that they expect it to be persistent for 0.4 or 0.6. It will usually be 1 minus non-persistent. So it will not be a great application. Yeah, and you have your EBITDA under your enterprise value to EBITDA. That is under your price multiples, right? So what we're saying is that you might have an alternative for your denominator. So these are the various denominators that you can have. Free cash flow to the firm, you can have net income, you can have this EBITDA These are the ones that you can have. So what we are simply saying under this earnings to price, enterprise value to EBITDA is that at times your free cash flow might be negative, earnings might be negative. So another representation to value the firm is your EBITDA, because it's interest before tax, depreciation, and amortization. And your enterprise value is basically value of equity, value of debt, value of preferred stock, and of cash. So you can also use that. So you can use a different denominator. So market base can be used across firms. It can be used across companies. It can be a momentum indicator. We also have what we call earnings surprises. So your earnings surprises is when your reported earnings beat the analyst forecast, right? So in that case, it can make your equity to also the value to increase. All right, so private equity valuation, everything that we have talked about, your dividend growth model, your is there a difference between invested capital and no, it's the same thing. So probably I come across question that does not consider short-term investment in calculating. Is there a situation that we can do that? No. So your short-term investment, yes, they might not want to consider it as part of your enterprise value, but most times your enterprise value is a combination of all. So, but yes, you can take it out. So everything we've talked about, dividend growth model, free cash flow, market base, you can use them under private equity valuation, but with some slight changes because it is private equity. Remember, your beta have to be adjusted. That is one. Number two, when you are calculating their rate of returns, you might want to consider liquidity premium, or let's say lack of liquidity premium, because private companies are not as liquid as public companies. You might also want to consider marketability premium, so lack of marketability. So all these should be considered when you are calculating the rate of return for private equity. Yeah, so for the market approach, you have what we call guidance public company method, which you look for the trading activity in the shares of the public company view as a reasonable comparable to the public company. So you look for the shares of a public company that is comparable to the private company, then you use that as a proxy for valuation. Or you can use what we call guideline transaction method. That is, you derive from the acquisition of a control of an entire public or private company based on what the established value or estimate is. So you look for the prior transaction that has occurred to be able to do the valuation. And we have different challenges that you can have. I've mentioned the lack of marketability. I've mentioned the lack of control premium, which you can use. Also, you have to understand that transaction can be strategic or financial. For a strategic buyer, the strategic buyer might be willing to pay more of the premium than a financial buyer. Industry factor too can affect the premium that needs to be paid. And also forms of consideration. Am I paying via cash or am I paying via shares? Anytime you are paying, because cash is king, if you are paying cash to buy a share, the people that are collecting that shares, they are assuming the risk, the future risk of the company as well. So that is why we normally say that the synergy in the combination of two companies, the synergy benefit that you are going to realize will be shared between both the buyer and the seller, between the acquirer and the acquiree. Now, that depends on your negotiation skill to check who gets what. Most times, when you pay cash, the acquirer gets more than when you use shares, because you are giving them shares to also be to also have access to the future risk of the company. Yes, then they will want more premium from that synergy.
the synergy is shared by acquirer and acquirer. Just need to put that. As a question, so GTM consider control, while GPCM does not consider control. Yeah, because what we are saying is that you've already considered what is here called. You are looking at the shares of what happened in the past for GPCM to be able to do that. And please, GPCM consider control, because the lack of control or marketability is what you will use to discount the returns. Okay, I said GTM consider no. So they consider the control. GTM consider most of the synergies, how the synergies will be shared. Is it going to be shared? Who gets what first? But the GPCM is one that will consider all the controls, all the marketability, etc. Yeah. And the last one is asset-based method. Asset-based method is just your total asset minus your fair value of asset minus fair value of liability. And that is the discount for lack of control that I've mentioned. So if you see the table here, you see this small table here, method, I say GTM, base of valuation, you consider what? Control. Can you see? Discount for lack of control expected, yes. Can you see? GCPM typically is minority. Do you consider lack of control? No. But the other ones, the prior transaction and ETC and free cash flow, do they consider control? I know it depends on the cash flow method that you want to use. All right, that's it. All right, so this is the question. Good. So I think we have about 40 minutes more. Yes. And I have a lot of questions that I want you guys to do. So now, this is the question. Can you guys quickly check this? Can you guys quickly check this question? Then we will look at the, so this is the scenario. Read this scenario, we will look at these questions together. Give me your answers on these 5. But read this scenario first. I have so many scenarios here. I don't know if you can spend like 15 minutes each. Hopefully you should be able to do like 3, 4 blank essay. So person with a good score gets something. And at the end of the day, you see where the questions are coming from. I put all the sources there. Right. So yeah, if you read this, when you're done with this scenario, just put it down there. Or let's do this. I will allow you guys to read this now for 10 minutes. According to the question, you do it for 5 minutes. Then we move to the next one. Sam, just hold on. Huh? We already time it. I'll give people 3 more minutes. Then I'll move to the questions. Yeah. All right, guys, I move to the questions now. So let me give you another idea. I think what you can do is when we have the questions, while you are reading the questions, or when you are reading these scenarios, because you likely still want to go back to these scenarios, when you are reading these scenarios, you can just screenshot it, put it somewhere, so that when you are seeing the questions, you can still go back there to see how you want to. So these are the questions. That's the 5 questions there. So guys, try to screenshot this scenario now. Can you all screenshot it now so that it's easier for you to go back to it while you're looking at the questions? Yeah. Is it done now? This is the question again. Because what you will see in the exam will be scenarios. So another thing I want you guys to do is this. Give me all your answers in one message from 1 to 5. This scenario has only 5 questions. So give me your answers in just one message so that it's easier for us to track. If anyone will even get a prize at all. Yeah. Thank you. That's the question again for people that are yet to screenshot it. Then I go back to the questions. Yeah. You can take it down. You can take another screenshot of this scenario there. That is it there. For people that want to do that. I'm back to the questions now. Can you start bringing your answers now? You spent about 15 minutes here, yeah? Give me all your answers, the 5 answers in one message, yeah. Guys, no one has given me answer in 15 or 18 minutes. This is too slow, yeah? You need to be fast in the exam. You need speed. You need it. Okay, Lamide, well done. Muideen, well done. And see Lamide, Muideen, who else? These are the 2 that I've given me. Olayinka, I want all. You said all B. Olayinka said all B. Muideen said 1B, 2B, C, B, 4. Okay. Lamide, okay. More answers. In the next 1 minute, I will review the answers. I will reveal it. Yeah, so that you can give others that are still trying a fair chance. Because this is what you need, guys. You need question solving. Uju, nice one. You need question solving. This is what you can do at his point. Yes, you can quickly revise the theory, quickly revise some technical stuff, which is what we've done in the last an hour plus. But you need to start solving questions on your own, make mistakes on your own, get the nitty-gritty of the issues, get to understand how the questions are being asked. Then it's easier for you to be able to do well in the exam. I'm expecting more answers by 2:07. I will reveal the answers and you'll see who scored what. Yeah. Okay, so guys, let's move on. These are the answers. Actually, 1 to 5 is B. For people that got all this, I think Sam got everything right. And who else mentioned all B? Olayinka. Sam and Olayinka. So these are the petty things you need to, these are the trips there. These are the tips. For number 1, you have to unlever the beta first. Then you lever it, you get it. Then you can use it to calculate your CAPM. Number 2, you have to use the beta multiplied by the 3 factors for the hammer and French. And number 3, what you just need to do is just that expected. He said I got to. I didn't see your answer, yeah? I didn't see your answer. I can't see your answer there. Let me see again if your Oduayo is there. Yeah, Oduayo, yes, I can see now. I can see. So if you see here, they said the expected for number 3 is mainly expected long-term return plus equity risk premium. This is when we are using the build-up method. Your number 4 is just calculation of your WACC using your ash total, and for your GGM, it's just your risk-free. That's your dividend yield or the market base, plus the concession long-term growth rate, plus the current long-term bond yield. You know, like I said, the examiner will just give you like dividend yield in the exam. And so congrats to the 3 guys that scored that. And this is his source, is in your CFA curriculum volume 3, is on page 327. That is question 20 to 24. So try to go through as many questions as you can. I want to go to another one now, another question now. Let's see if you're able to, if you are able to finish this before the 2:30 time. Let's see if you guys can do 3 scenarios. That's when I can choose a winner, right? I cannot use 1 scenario to choose a winner. So be fast here. Let's see what you guys can do here. Be fast. If you can't choose a winner, nobody gets any prize. Muhyiddin, give me all your answers in one distance, yeah? Just in one message. So are you guys done reading this? This is the number one question, right? Can you do a screenshot of it? By 2:15, I'll go to the question. So I'm just still giving people the time to read it first. Would you? Okay, I'm moving to, I want to believe you've all done the screenshot of the scenario with the first question. This is the remaining questions. You have 7 there. I'm back to this scenario again. That's it. Read it again. Get the screenshot. And these are the questions again. I still have a lot of scenarios, but time will not permit us, but it's okay. Also, you see, I think Frank or one of the Houston, they made mention of this. There's a forum there. Go to CFA Society Nigerian website. We have a forum for candidates there, study group, try to join. And if you have any issues, the society can see if they can actually help to contact someone that will help out in any issues I might have in any of the courses, right? Yeah. The link to the group was pasted earlier by Oyin, I'm sure. So you can check that out as well. Okay, keep your answers coming now. You should not be this, okay, PJ, I don't know the meaning of PJ, but it's okay. Yeah, you have 1A, C, 2A, B, A. Okay, let's see. By 223 or 24 marks, I'll reveal the answers and we'll see if anyone will get a prize or not. Only has pasted the link to the forum again. Please try to join the study group here. Okay. Aminu said all is C. You will see so. Okay, Muhyiddin, I can see your answers there. 1 month in it dies, then we can review the answers, we can look at it and see. So I'm surprised, it's only PJ, Muhyiddin, and Aminu that attempted this, or all of you are still trying to get the answers. Nice one, Uju, Jide, well done. Let's try and see if others will be able to get this. Since we cannot solve as many scenarios as we have learned to solve, but okay, let's see. Okay, let me review the answers now because we still have a small feedback session after this class. That is 4 minutes time. So let's see. All right. So the answers are this. The number 1 is C. All you just need to do is just to use your dividend discount dividend formula. The number 2 is A. What they're asking for is your justified trading PE. Number 3 is A. So the question is talking about range. So you have a value which is plus or minus, is it 10.62%? So add for the upside, check for the downside. So if you see the downside is even higher than the price at 34 or so. So that means that this guy is still overvalued, right? So the number 4 is B. You have to calculate the returns and use dividend growth model. So you have to first of all calculate the return on the asset, then you now use it to do your dividend growth model. The number 5 is A, the number 6 is A. Where did I get this from? It's from column 3, page 487. That is your question 16 to 21. So how many people got this right? Sam, did you get anything there? And you seem to get all of this second one. Would you try it as well? I think you got everything right as well. Doing okay. I think you guys so everything is not C. Let's see PJ did one. Okay, I think PJ got it right. Okay, I think you guys did well. And Moody said he got all. I can't see, where did he get all? Ah, yeah, he got all. Yeah, I see. Okay, so that's that, guys. Well done. I wish you all the best in your exam. I pray you'll be in a good shape of mind, physical and everything before you, on that day, and you'll be fine. So please, don't fast on that day. You can fast before the day. Don't fast. Maybe you can even fast after the exam. But all your preparation, try to do it before the day. You need your mental alertness on that day. And if you don't eat anything, if you don't drink anything, you'll be dehydrated and you get cranky. And you might not be able to read the questions properly. Note this first. English is the exam is set in English, and English is your second language. So you need to be mentally alert to be able to even comprehend the questions before you can be able to answer properly. So I wish you all the best. The society wish you all the best. In my private capacity too, I wish you all the best. If you have any issues, if you need any further clarification, anything, you can contact me. I'm the chair for membership committee for CFA Society, and I'm here to help you guys and to guide you through your journey in this CFA program. Thank you so much. And this concludes our maiden edition for the level 2. I want to say that I'm proud of you guys. You guys have done well with all the tests I've given to you. I wish you all the best, and I pray that you guys, you'll be able to say that the maiden edition helped you guys to pass and move to level 2. Thank you so much, guys. And I give the floor back to Yemi so that we can quickly have a feedback session and and close the
Thank you. Thank you so much, Mr. Shegun Jimo, for helping anchor the maiden edition of Ethics for Level 2. We are now in the feedback session. We would like to hear, this part of the whole program is dedicated to our candidates, both Level 1, Level 2, and maybe Level 3 candidate that got information with regards to this session. We'd like to hear from you how the society can better support you in your journey to earning the CFA charter, and also whatever suggestions you may have, comments you may have with regards to this bootcamp and maybe any other issues that revolve around your exams. So I'll yield the floor. The housekeeping rule is for, I think there is the icon there for raising your hand so that I can allow you speak, and we'll take note of everything everyone has said. In the meantime, before we begin, we had a candidate conference, I think earlier in the year. Shegun, if you can remind me, and some issues were raised, and those issues were escalated to CFA institutes, and I believe they were handled, and that's the benefit of this kind of exchanges that we as the society have with candidates, to hear what candidates are facing and how we can support you in your quest for the charter. So I don't know who wants to go first as to any comments, any observations that you may have. It's supposed to be a very short session and directed by yourselves. Okay, Jide, hello. Can you unmute yourself and go ahead?
Thank you very much. Good afternoon, and many thanks to the society for this session. I think it's been very, very useful. I'll make my comments very brief, and there are two main comments I have, which is with respect to the administration of the exam itself. So I had suspended writing this exam for quite some time, but I got back to it in August. And I was quite shocked at the degree of physical, I don't want to call it battery, but the way people were set to go into the exam hall, to the extent where they have to lift up their trousers or pull down their socks to see if something is hidden somewhere. I felt that was very embarrassing. I've written this exam in 2 other countries in the past, and we never had to go through that degree of dehumanization, if I may use that description. So I don't know if this is something that the society can look into. I did give the feedback to the institute at the end of the exam on that day, but I don't know if that has been addressed. My second comment is also with respect to the quality of the equipment used at the center in Ikeja. I think those desks